in the next 24 to 48 hours. What if, I ask you viewers, what if there is some bit of resolution between now and 9:30 a.m. tomorrow? So I think lots can happen, right? So let's wait and watch. Okay, but remember, while the tariff piece is on,
Sorry, Neeraj, for interrupting. Love the optimism, though.
that's what bull markets are built on, right?
Absolutely.
Simple. Okay, but the optimism also stems from the fact that the government has done a lot now in the last few days to try and tackle this. And as the festive season kicks in and the GST reforms are about to be announced, well, I think one of our colleagues had a nice visit to Vijay Sales and a conversation with Nilesh Gupta, the director of Vijay Sales, on how he's gearing up for the festivities. What did he say?
I think the key takeaway for me was that he said that from last year's base, which was already a high base when it comes to festive sales, they are expecting a growth of 15 to 20% post GST. And he said that if this comes into play on 22nd of September, that is first day of Navratri itself, he is very optimistic that this 15 to 20% will grow through. And I think that was the key takeaway of what he told me. In fact, listen to what he had to say himself. Today, we are at a very special location. We are at Vijay Sales store talking about the new GST reforms and the boost in consumption that is to follow, and of course the festive demand and how are the sales looking like. And to discuss as to how things are faring at Vijay Sales, we are joined by Nilesh Gupta, who's the director at Vijay Sales, joining us now. Always a pleasure speaking with you, Mr.
Thank
Gupta.
you for having me here.
My first question to you is that, I want to understand that with regards to this new GST reform that we're talking about, where GST will come from 28 to that 18% mark for ACs, plus your 32 plus inches TVs as well as dishwashers. How is the industry viewing this, and how is this move being welcomed by the industry?
So I think the industry is viewing this as a Diwali gift by the government. Definitely, both the categories are very important.
Yeah.
The 32 plus televisions as well as the air conditioners.
Right.
And especially in the light of the air conditioning summer season not doing so well because of the rains, erratic rains, I think this is going to be a real breather for us, and it will definitely boost the sales.
In terms of the overall view as well, from a Vijay Sales point of view, from a retailer point of view, how do you think that this consumption boost, it's not just GST alone. There's lots happening that the government is in fact doing to boost the consumption, right? There was income tax cut, there was also rate cuts that's come in, there's 8th pay that's going to come in, plus this new GST reform. Lots, done by the government to boost the consumption. How do you think this will incrementally benefit Vijay Sales? If you can give us a perspective in terms of percentage as to what growth can come in from this consumption boost.
So what we are seeing is already the income tax rate cuts which were announced in the finance budget has translated into extraordinary sales for us. So the sales have gone up, and we are already seeing, in spite of a poor summer, we are already seeing a growth of around 10 to 12%, which otherwise would not have been possible. And now with this GST cut coming in, the positivity all around happening in the country, and the very fact that we are able to stand on our own irrespective of what's happening outside, I think it's a very positive impact. And in consumer durables especially, what matters most is not whether the consumer has money or not, but what matters is sentiments. So right now the consumer sentiment is up, plus he has money in the pocket. So it's a double whammy. So we expect a real good sales to begin once the GST sets in.
Got it. The expectations earlier were that this announcement will come pre-Diwali in October. But now there are talks around that indicate that it will come on the first day of Navratri, that is 22nd of September. I believe this is a welcoming move again, because if it were to happen in October, a lot of sales could have been deferred, and that would impact your Q2. Is that reading correct?
You are bang on. Had it come in October, because the Diwali sales begin from first day of Navratra. And then people are waited, especially those who are going to plan to buy larger size TVs and air conditioners. But since it's expected on the first day of Navratri, I think it will be a double whammy. Again, season plus price cut, plus the offers which the brands are going to give, which they give every Diwali, the retailers offers. I think this year we are looking at a bumper Diwali.
Absolutely. But in case this doesn't happen in Navratri and maybe pushes to Diwali, how do you plan to manage your inventory? Because I believe that you will have to, if it doesn't come in September, you will have an inventory overload and might have some costing impact for a month or two.
So I think costing impact of the inventory will not be there, because your input, you are going to take whatever you are going to pay to the brands, and the output will be there, and the difference is going to be passed on to the consumer. So I think from cost impact to the retailers or to the distributor will not matter. So nobody is going to stop taking the inventory because in case there's a delay. But we hope that it comes on the first day of Navratri.
Absolutely, and from the first reading of it, since Ganesh Chaturthi starts tomorrow, how is the festive demand overall looking like? What is the first customer sentiment that has come in so far?
It's a very positive customer sentiment, and as I said, in spite of a poor summer, we're seeing a growth of 10%, which is very good. So I think consumer sentiment is high, the festive spirits are high, and we expect real good.
Well, that's on the consumer durable side of things. But with tariff coming into effect tomorrow, auto and auto ancillaries also in the line of fire. With the highest US exposure, here's Somit with the list of sectors that may get affected and stocks, of course. Somit.
Well, yes, US is one of the largest trading partners for India. Now, if you look at FY25, India exported goods worth nearly 86.5 billion US dollars to the US market, which is nearly 2.2% of India's GDP. Now, do remember that not everything that India has been exporting to the US market comes under the 50% tariff category. The 50% tariff category is applicable only on the 67% of the India's export to the US market. Now that translates to around 58% of 58 billion US dollars, which is nearly 1.5% of the GDP, and the remaining are the sectors that come under 232, section 232, and some of them are also exempt. Now theoretically, if you look at the products that come under the, theoretically if you look at the 50% tariff is expected to impact nearly 70 to 80 basis points of the GDP growth as per analysts, and the categories that are exempted are nearly are auto, some of the auto ancillaries, some electronic items which includes chips, mobile, some metal products, some copper and its byproduct as well. Now let's look at the sectors that stand to get impacted. The most auto and auto ancillaries have the highest exposure to the US market. Samvardhana Motherson, Balkrishna Tires, Sansera Engineering, Apollo Tires have US exposure of close to 3 to 18%. Apart from that, if you look at chemical stocks, those have exposure. UPL 20 to 25% of its revenue comes from the US market, SRF 20%. Jubilant Ingrevia 9%, but apart from this, there are multiple other companies that have a large exposure to the US market. To name a few, it's Aarti Industries, PI Industries, Atul, Navin Florent, Deepak Fertilizer, Gujarat Fluoro, SRF, Vinati Organics and Alkyl Amines as well. Apart from that, it's the textile sector that could get impacted the most because US accounts for nearly 28% of India's textile exports. And the companies that have the highest exposure to the US market, firstly it's Welspun Living with 63% exposure, Trident 38% exposure, KPR Mill 19% exposure, Alok Industries, Himmat Singha and Arvind have an exposure of anywhere between 37 to 83%. Then there are shrimp exporters and shrimp feed exporters that also get impacted. Avanti Feeds has a revenue exposure of 14%, Apex Frozen and Water Base has a revenue exposure of anywhere between 40 to 63%. When it comes to consumer companies, very few of them have an exposure. Some rice exporters like LT Foods and KRBL have an exposure of anywhere between 10 to 39%. Tata Consumer has an exposure of close to 12%. When it comes to new energy companies, no impact largely on utilities and renewable energy developers, but some impact we could see on solar PV cell module companies, because Vari Energies is one of the companies which has nearly 57% of its order book coming in from the US market, while Premier Energies just has 1% of its order book coming from the US market, but they had plans to expand in the US market, so that could get impacted going forward. And lastly, when it comes to the oil and gas space, no direct impact, but India currently sources around 35 to 40% of its crude requirement from Russia, and if they plan to change that, then the crude cost could increase by around $1.5 to $2 per barrel, and this increase in crude cost will directly impact the marketing margins of Reliance Industries and OMCs. Now, if you look at the EPS or the EBITDA impact for Reliance Industries on a consolidated level, it could be around 3%. For oil marketing companies, it could be around 10%, because every $1 rise in crude oil prices impacts the marketing margin by around 0.5 rupees per liter for the oil marketing companies. But there are a host of other sectors that stand to not get impacted at all because of this Trump tariff, and those are the domestic focused companies, sectors like FMCG, Telecom, real estate. Nearly 95% or more of their revenue comes in from the domestic market. IT services again does not get impacted because of Trump tariffs. Apart from that, there are sectors like capital goods, insurance, bank, power and steel companies which have most of their revenue coming in from the domestic market, and hence they do not stand to get impacted from the Trump tariffs.
Okay. Okay. Important ones. And thanks so much for bringing us those details, Somit. Let's get in an expert voice to try and understand what to do in a scenario like this. What is it that they in their portfolios are doing? Manish Sonthalia, Director and Chief Investment Officer at MK Investment Managers, with us on the show. Manish, always good talking to you, and you know this, but thanks for taking the time out, especially today, because it's interesting that we are now on the cusp of the tariffs possibly coming in. The US has notified that they take shape and form unless something changes in the next, 18 odd hours. What does it mean for the markets?
So, Neeraj, the tariff of 50% has been digested by the markets with today's correction. It's an event which has basically played out. As you have rightly said, $86 billion, out of which $60 billion will likely get impacted, the rest being exempt. These are certain pockets which are likely to get impacted for till the point in time you have this 50% tariff. Now, the moot point is how long can this last? And you have to make some presumptions out here. I would believe that, US has a lot of investments into India. And this 50% tariffs mean that basically it is a sanction. And all of these guys are likely not to export anything with 50% tariffs. And by and large, if they have to absorb the entire 50% or even 25%, basically the margins are not going to come through. So particularly textiles, etc., they operate at single-digit margins. And if the buyer asks you to absorb 25% of this 50% tariff, obviously you can't run your business in a loss. Similarly for other sectors. So all in all, I would like to believe that this number of 50% will get whittled down somewhere down the line. You don't know when, but likely in the next 3 to 4 months to anywhere between what other countries are paying. By and large, 15 to 20%. And electronics, pharma, specialty chemicals, these are some of the areas where a lot of exports go to the US. And mind you, there are going to be shortages, and supply chain cannot be really catered to on the alternative side in a hurry. And so I would believe that from a market point of view, nothing much to worry about. Assume that $60 billion, half of that will get whittled down. In terms of impact, $35 billion will have to find a new market. Government will do its bit in terms of helping the exports to other markets. RBI will do its bit in terms of lowering further rates, enhancing liquidity. And, that is how this whole mitigation of the tariffs is likely to play out. As it is 1.5 to 2% on GDP, the growth rate, 50 basis point, will be taken care of by incentives given by the government and the central bank. So I would believe it is a buy on debt market, buy at 25,000. There's nothing much to lose on the downside.
Okay, Mr. Manish, hi, Mahima also joining in. Just want to understand, considering the kind of year-to-date performance that, we've seen in terms of the benchmarks as well as the broader markets, what are you suggesting your clients right now to do? Are you keeping dry powder right now to maybe, see the right point to enter? Or are you deploying your money? And if yes, where are you deploying it?
So don't look at the broader markets index per se. Focus on individual stocks. That's the best way to go about it. I think if you look at the headline indices this year plus next year, average should be around 10% growth. And you couldn't give a better multiple than 22, 23 times on a 1 year forward basis, given the anemic earnings growth of 10 to 12%. Broader markets, again, the Nifty 150 mid cap, or it's in NSE small cap 250. You have to buy that 25, 30 odd stocks. There are ample stocks which are growing at 25 to 50%. There are also stocks which are growing negative. It's a pick and choose sort of a market. Focus on domestic themes. 77% of India is basically domestic. We produce and consume assets. Some of the areas like Pharma, CDMO, etc., we have a right to win. IT probably has seen the worst. Real estate is swimming in the economy is swimming in liquidity. Credit demand in the system is not that adequate given the low cost of capital. Will find its way into speculative demand. So real estate, capital markets, all in all, these are NBFCs to say the least, and public sector banks. Now the private sector banks, because this quarter, first quarter, has seen a lot of a bit of stress building onto lending financials balance sheet. MFI in any case was a worry. You still have another 2 quarters to go, for the full provision to come through. So there are certain pockets which look okay. Valuations is something which one needs to keep an eye for. This is the only big worry in the market. Not everything is viable, not everything is sellable. I think if we stick to reasonable price earnings growth multiple, given that markets today are trading at 2 times price earnings growth, there's ample room to pick and choose.
Got it. Manish, Harsh joining in. If I were to venture more towards IT and try and understand what it is that is in store for the IT sector and the space as a whole, there's just so many moving parts. So trying to understand possibly 25, maybe even a 50 basis point rate cut, would that be enough sufficient to drive the sector earnings and growth? Would that make a comeback likely in the next year?
So basically, the mid-tier IT companies are likely to fare better than large-cap IT companies because the buzzword is today AI disrupting jobs. And, large-cap IT companies are hiring maybe 500,000 or thereabouts sort of employees, and all of them are not reskillable. Because if AI is to disrupt segments of the IT, then people needs to be retrained. This is more doable in the mid-cap IT names. They would be more nimble-footed. And from that point of view, mid-tier IT companies' growth should be better than large-cap IT companies' growth. Not to say the least that order book positions for both large-cap and mid-cap IT companies are swelling. It's just that execution has been in a limbo for some time due to the slowdown issues facing the developed markets. But valuations at the same time have corrected significantly. And I think from this point of view, from looking at this lens, we think that there is ample margin of safety in the IT names. Whatever correction had to happen has already happened. And given that on a 1 year forward basis, these are trading at lower than historical valuations, I'd be venturing out more in favor of mid-tier IT companies than large-tier.
Manish, one final question. You attended a clutch of investor conferences, I presume. It is still the conference season. What has stood out? Last year, you had told us about the recycling theme, if you will. What has stood out this year?
Consumption. If you speak to entrepreneurs and, the conferences that we attended, ask one simple question: what do you make of the tariffs? He said that, everybody is gung-ho on the domestic market per se. More so after, our Prime Minister has announced his GST rate cuts. I would believe that consumption is going to come back big time. Last few years, especially post-pandemic, it is all about investment-related themes, right? Whether it be power, whether it be renewable, whether it be defense, railways, capital goods, valuations have gotten very full. This time around, the heavy lifting of growth for the economy, that 6% or 5.5%, given the impact of tariffs, will be done by consumption. Last 2-3 years, consumption has not done well because of very high inflation, very high taxes. That is moving at the margin in favor of the middle class. So all middle class related consumer is likely not only to see earnings boost, but also valuation re-rate. So from that point of view, automobiles, we already started seeing re-rating, fast fashion, QSRs, leisure, travel, hotels, a whole lot of them, health insurance. Some of these areas, the conferences, people and managements are quite optimistic.
Okay. Okay, Mr. Sonthalia, thank you so much for giving us those insights. And clearly, consumption is a theme to play, and the markets are cheering that today as well. The defensive play is doing its role. Thank you so much for taking out the time and speaking with us at NDTV Profit. Let's shift focus. Key ministers are likely to meet PMO at 3 p.m. ahead of the 50% tariff hit. Rishabh joins us with more details on that. Rishabh, what is the agenda?
Right. The main agenda of this meeting is expected to be a review of the export promotion mission that was actually announced in the budget in February and hasn't been launched yet. But what we're hearing is that it could be launched with a 25,000 crore rupee outlay. Now, remember, this comes with two sub-schemes. One is Niryat Protsahan and one is Niryat Disha. Under Niryat Protsahan, the main vessel of support for exporters will be export credit finance. That is number one. And under Niryat Disha, you have targeted support for export compliance, for diversifying to newer geographies, branding, marketing. You have trade promotion stuff coming under Niryat Disha. So about 10,000 crores is what we're hearing has been assigned for Niryat Protsahan, about 14,500 crore rupees for Niryat Disha. This export promotion mission is awaiting clearance. It is currently with a panel within the finance ministry, the expenditure panel. They are going through it, and it will continue. Then it will move to the cabinet for approval for a fast rollout. So that is what we're picking up in terms of this key meeting today.
All right, Rishabh, thank you so much for giving us those updates. We'll keep a close track on that story as well. Now, time to look at the stock of the day. Vodafone Idea in focus. The stock has cracked after the news around AGR dues. My colleague Soumya joins us with more details and the kind of moves that the stock has seen today and what's the cause.
Well, if you look at Vodafone Idea share prices on intraday basis, the stock was down nearly 11%, which is the biggest move that we have seen since May 19, 2025. Now, why this move we have seen in Vodafone Idea? Because earlier, in fact, last week, Thursday, Friday, there was this news report which suggested that company might get in some relief on the AGR dues, but yesterday or today's PTI report does indicate that Department of Telecommunication is not contemplating any such AGR relief to Vodafone Idea, and that's the main reason why the stock is down 11% in trade. Now, why this relief was very important for the company? Because this AGR dues needs to be company needs to start repaying this AGR dues from FY26, and if you look at the amount that the company needs to now pay, if you calculate the spectrum and the AGR dues, that amount stands at close to 19,000 crore rupees. That is the amount that they have to pay at the end of FY26, a total of spectrum and the AGR dues that the company needs to pay. Now, if you compare this to the cash EBITDA that the company generates, is just 11,300 crore rupees. So it clearly shows that the company might not be able to pay this spectrum and AGR dues by the end of FY26. So hence this was quite important. Apart from that, if you even look at the fact that the company has been trying to raise debt from the bank, but it has not been able to do so, and that has also led to more losses for the company so far, because the company has not been able to conduct more capital expenditure, and less capital expenditure has also led to lower network upgradation, which has impacted the company's subscriber and the market share as well. If you look at since FY18, the company has lost close to 22 crore subscribers, and the market share loss has been nearly 24 percentage points. On the financial side, if you look at, the company has been reporting losses for 30 consecutive quarters, and the cumulative loss amount is more than 2.1 lakh crore rupees. Now, because of this drop in the share price of Vodafone Idea, even Indus Towers has been falling because it has a collateral damage that has been happening, because Indus Towers gets nearly 1/3 of its revenue from Vodafone Idea, and any lower capital expenditure or less funding coming into Vodafone Idea will indirectly impact Indus Towers as well.
Okay. Thank you for that, Somit. Thanks for breaking that down for us, both with regard to Vodafone as well as the bit with regard to Indus Towers. Piyush Pandey, Telecom analyst, Centrum Broking, joining us on exactly this. Piyush, what do you make of it? And as an investor of Vodafone, what should one do? Because one day the stock is flying, and the other day you have another negative announcement which is keeping a lid with regard to the way the stock has actually reacted the previous day. So how should one look at Vodafone very, very objectively?
So it has become sort of like a speculative stock. So I would say, despite Q1 being a little better quarter, the concerns remain, like concerns regarding loss of customer base, debt remains very high, and also like they need to do a significant part of the 4G and 5G capex. So the company requires some relief from the government. Also, they need to raise funds from the banks and other investors to complete the remaining part of the capex program. And so as such, I would say they have made certain good positives in the first quarter, but challenges remain. And I would say in the absence of a near-term fundraise, along with some help from the government, the situation remains somewhat precarious. It's sort of like it, I would say, more of a speculation is involved, and it might be even best. If it gets relief from the government, then the stock can do well. If it doesn't happen, then it might like say it might uh, just remain at current rupees 7 to 8 levels. So fundamentally, I would say the sector has become sort of like a duopoly with Bharti Airtel and Jio, and Vodafone is sort of struggling, losing markets here. So it's just like a duopoly where two players gaining markets here, and they have the pricing power. So now you are seeing in a sector-wise better ARPUs, and the
Right,
uh,
right.
yeah.
Sir, if you look at Vodafone Idea, there have been a couple of rounds of fundraise, one in 2019, one in 2024, I believe, and 2023. Apart from that, there have been multiple rounds of debt conversion into equity. But despite all this coming in, the company has not been able to turn around, has not been able to gain subscriber base. So what is that one factor that Vodafone Idea would need for a turnaround going forward?
Yeah, of course, there has been multiple rounds of fundraise as well as debt equity conversion. But in fact, I would say this was the last. I would say the last Q1 was sort of where some sort of positives were seen, like where the churn drastically reduced, and company was able to add a reasonably good number of 4G and postpaid customers. So I would say now I would say that the company has reached a stage where I would say any significant fundraise and any help can materially change its condition. Like so, 2 to 3 years ago, 2 to 3 years ago, I would say the gap was significantly much larger between our top two players in Vodafone. But now I would say they have launched 5G in say 13 circles, plus quality of the network has improved. So I would say the time is I would say time is right when any sort of help to Vodafone Idea can really help it to uh, I would say emerge as a somewhat stronger player.
Well, sir, shifting focus from Vodafone Idea to Industars. Now, one of the other major overhang on Industar, apart from Vodafone Idea, is the fact that they have yet to announce that dividend. So, what is your internal estimates suggesting by when can the company announce their dividend policy, or will they go ahead with some other form of cash utilization policy? Can there be a acquisition as well?
See, currently in the tower industry, we have just two big players. Like say, one is like say Indus, and other is like say Brookfield. And the sense is that like say Indus might look to acquire some of the smaller players in the industry. Like so, industry has roughly 6, 7 any material players. So out of which Indus might look to acquire, and with scale, they can get a better pricing power. So I would say near term, it's about it makes more sense for Indus to acquire smaller players, build a scale, get some pricing power, and then they might announce a dividends. It looks like more probably towards the end of FY26.
Piyush, in terms of the triggers for the sector going forward, other than tariff hike, any other triggers that you think that can augur growth?
See, tariff hike is one thing which is very likely because you have just two big players. And also, I would say, like, see, we are seeing more traction in the case of home broadband. So, home broadband 5G FWA, where last quarter, in fact, both Jio and Airtel added significant number of players, and that area still looks, I would say, somewhat underpenetrated. So, it provides another room for growth in terms of customer addition. So apart from that, you would see like say 2G to 4G migration, and in fact over the last few quarters, postpaid addition also improved. Like so, you are seeing better postpaid addition for Bharti as well as for Vodafone also last quarter. So these are some of the organic triggers. So besides tariff hike is likely. So it makes more sense for the industry to somewhat change the pricing structure. Like so, in the next round, it is very likely that industry might see tariff hike at the upper levels of plans, and some of the voice only plans and lower levels. Uh, the increase might be very minimal, but at the top range, you might see significant increase because this has been the argument of both Bharti and Vodafone that pricing structure is somewhat distorted in India, and where people who are consuming at a much higher rate, they are somewhat underpaying. So the range of prices in terms of minimum and the maximum, that range has to be increased. Where people, especially voice only plans, they might remain.
Noted.
Their pricing only, like say, increase will be minimal. For people who are consuming 30-40 GB per month, I think they might see more increase in percentage terms.
Got it. Okay. Piyush, thanks so much for giving us those updates. Really appreciate your time.
Thank you.
That's the view on telcos, Jio versus Airtel, if you can call that battle. And is there a battle in versus bulls and bears in the last 1 hour of trade left? Well, what are dealing rooms saying about that battle? Sumit Sarkar Johnson with all the chatter from the dealing room. Sumit, what are you hearing?
Well, multiple stocks remain in focus. Firstly, Edelweiss that we saw today, a big block deal happen around 64.5 million shares, or 6.43 million shares changed hands in the pre-open window, and dealers are indicating that the promoter Rashesh Shah might have sold some of his stake here, and the buyers could be one of the buyers could be a Bacchus fund as well. So keep an eye out for that. The block deal data would be important to watch out here. Aptus value and translate writing is also in focus. Dealers are indicating that there's a buzz of a potential block deal that could happen very soon in both the counters. For Uptown, dealers indicate that the company might announce a fundraise via preferential issue, as multiple HNIs and PMS have given their commitment for this fundraise. So keep an eye out for Uptown as well. For Nazara Tech, the stock has fallen nearly 30% owing to the news regarding the gaming sector. But now the street believes, in fact large HNIs and PMSs believe that the selling is largely over, and there is value buy when it comes to Nazara Tech, and hence there's some buying interest that we're seeing in Nazara Tech in trade today. And lastly, when it comes to Sai Life, TPG completely exited via block deal today, and what I'm picking up from dealing room is the fact that 50% of the block was bought by long only funds, and few of the prominent buyers of this block were Invesco Mutual Fund, Axis Mutual Fund, Bandhan, and Goldman Sachs AMC.
Sumit, just one quick follow-up here on two stocks. One, typically clean-out trades lead to a stock moving up. In Sai Life's case, that's not happening. Why is that the case? Are dealers saying anything about that effect?
Well, just 50% of the book was actually bought by long only funds. Well, the remaining 50% is by most likely hedging companies. So that could be one of the reasons why the stock didn't react the way it should have reacted.
Any thoughts that dealing rooms have around Uptown? Simply because it's a stock that has been in existence for a really long time. I heard you say that multiple HNIs have given commitments. There has to be some very strong reasons for that to happen.
Well, I actually do not know what's the kind of upside that could come in on the stock.
No, forget the upside, but
what is the
reasons?
kind of growth plans they have. But what I'm picking up is that existing HNIs who are already invested in the company have also given their commitments to invest, and the fundraise could likely be happen at a higher rate is what the dealers are indicating. But then this has been in news for quite a while that there might be some fundraise. Now the news is that there could be a preferential issue, and they have already spoken to a few investors. So that is important to watch out. But I do not know what are the growth plans here for the company.
Got it. Okay. But Sumit, thanks for bringing all of those updates. Really appreciate your time. Let's put some of these questions before we get in the market-wide conversation going. Kush Bora, Vineet Bolinjkar join in. Gentlemen, thanks so much for taking the time out. Kush, I know you look at a lot of things that Sumit says very, very attentively. For 3 or 4 very interesting names today, what did you make of any of them?
Sure. Hi, Neeraj. I think first of all, very good afternoon to and wishes of Ganesh Chaturthi to you and to all the viewers.
To you as well.
A couple of names that do actually stand out for me. First one is actually Transrail. This one's actually been consolidating for some time. The downtick is on fairly low volume support near the 20-day moving average. I would keep this on my radar for a sharp up move, in the coming days. The other interesting stock is Uptown. While you were, conversing with Somit, I actually happened to look at the monthly chart, for Uptown. And the last 3 months, the stock has more than doubled, and the volumes have been staggering. So definitely there is some accumulation going on in Uptown. So definitely want to be kept on the radar. And as a contra buy, and in fact, there is something even that Somit mentioned, is Nazara Tech deeply oversold now. I think the selling seems to be coming to an end. At least the volumes on the downside have actually stemmed, 200-day moving average support kicking in. So this could see a rebound, maybe not a V-shaped recovery, but at least, if you want to start initiating some sort of, a buy, Nazara at these levels does make like an interesting, entry point from here.
Okay, all right. That's an interesting one. Nazara makes a good entry point right now, as the view Kush has. But with that, it's time to slip into a very short break. But before we slip into a quick break, let's hear Maruti Suzuki's chairman, R.C. Bhargava, talking about scaling up EV production and demand in the segment. Listen.
So the scaling up is essentially going to depend on how much demand grows. We are using one line of the plant. One line normally has a capacity of 250,000. How much of that we will use will depend on demand, and can scale it up if the demand grows adequately. Even announced domestic sales.
Yes, that's it.
Domestic sales still to be announced yet. Till that time, all that is going to get produced will be exported. Globally, what is happening, what we have seen, is that whether it's the United States or whether it is all the major European countries, Germany, France, UK, Spain, Italy, or it is now even China, EVs and hybrids are both selling, with hybrids being slightly ahead in all these countries except China. China EVs are ahead of hybrids. But in recent couple of years, even in China, the hybrid sales have accelerated substantially. So the picture as it looks globally is that there are customers who prefer EVs and there are customers who prefer hybrids. The government seems to be pretty neutral in all these countries because the tax rate, again except China, between EVs and hybrids is very similar in the USA, in these European countries, and Japan, of course, is mostly hybrid.
Tech has changed, so should your tech show.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed. So should your tech show.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up.
Welcome back. Thanks for staying with us on India Market Close. I want to quickly go across to Kush. Kush, your picks for this afternoon?
Sure, Harsh. I've got two long calls. One is Dalmia Bharat. The stock seems to be holding ground. It has been consolidating with some positive bias, interesting volume moves on this one. Not very big, but still, about 20 days moving average. So that's also a healthy sign. 2390, 2435 are the targets. 2300 is the stop loss. CG Power is one stock that had held the ground for the most part in the slip that the market gave in the last few minutes. It slipped into the red, but it's still consolidating above the 50-day moving average, so can still be considered on the long side. The volumes on the downside aren't really as big, so I do believe that the relative strength is apparent on the CG Power. 690, 700 are your targets, and 670 is where you place that stop loss.
So that's the take coming in. Vineet, very, very quickly on some of the power financiers. Do you have a view? Because we've seen a bit of a slip on both of those power financing stocks. I'm not sure whether we're seeing that same move on IREDA, but Vineet, your take?
I think IREDA is extremely overvalued according to me, but the other two stocks definitely are a good stock to buy into. I like both REC and PFC.
Between the two, Vineet?
Both of them, because one is the parent of the other, right? So both of them are good to go with. Great dividend yield plays, and have got a long runway of growth ahead of them.
Okay. So watch out for those. Vineet, just wondering, are you cautious right now or are you constructive?
I'm constructively cautious. So continue to remain skeptical of this bull market. I think, as we spoke last time, the credit event is very near now. In the US, their balance sheet is just out of, has got a lot of stress. They need to fund it. And Trump has gone berserk with all his actions, and none of them are yielding result. So I think they're going to go in for a hard landing instead of a soft landing. Inflation is going to go through the roof, and that is going to be a tell on interest rates all over the world. So I think we will see the equity risk premium contract, and to add to that, we need to get our export house in order because of the tariffs. So long way to go. Very, very a lot of headwinds to pass. So remain constructively negative on the markets.
Well, okay, thanks for that, Vineet. And Kush, we'll come to you in a moment. We want your market view as well. But we have 5 minutes with Jonathan Shizel. He's Deputy CIO, Westminster Asset Management and Johnson right now on the show. Jonathan, thanks so much for joining in. The ask of having you today or having your opinion today is because as things stand, there is additional 25% tariffs on India coming on in the next less than 24 hours. Now, do you think this has been baked in, or do you reckon this can have ramifications for Indian equity markets?
No, I think, good morning, hi there. It's hard to believe, looking at where the indices are, that the additional tariffs is baked in, to be honest. Yes, we all know India is primarily a domestic focused economy, and the impact will be hard in certain sectors, but broadly speaking, I guess India will be impacted than more export-orientated economies. But yeah, I think your point's a valid one. I don't think it is baked in. I think there is still a certain degree of hope that something will be agreed before the deadline.
So should that not be the case, Jonathan, you suspect that there is downside here. Would it be market-wide, or would you believe that investors might make an exception to the domestic-facing sectors and, maybe punish the export-oriented ones? Or would you believe it will be a lower tide which will carry all boats along with it?
I think probably initially you might get some India-focused selling. I think we've seen, the index, we're not at all-time highs. The index has been struggling a little bit of late. So I guess we've seen some of that. You might see a little bit more, but absolutely agree with you. I think the India-focused players might switch to more domestically focused industries and away from the exporters. But, if you look at tech stocks and some of the other sectors, they've already been in a pretty miserable place for some time. So you could argue that there is some negativity beginning to be priced in.
Jonathan, Harsh here. Give us your perspective. FIs have been consistent sellers. What's it going to take to tilt the scales?
Yeah, I think the macro actually is looking pretty good in India. I think the issue has come, India just had done so well compared to China over the last 5 or so years. And obviously Chinese markets have been roaring ahead. And you've just seen money coming out of India to chase that up. How long that can go on, I don't know. I think China still looks pretty cheap, so it probably can go on for a little bit longer. Ultimately, with the dollar weakening off, it's good for the entire complex. So, I still think there will be passive money coming into India. But that said, the India growth story still looks pretty good to us. Yes, this wobble with tariffs creates uncertainty. But it's at the end of the day, we're not too far off the highs. We shouldn't get too negative.
And Jonathan, how are global markets, bond yields tying into everything that's happening? Give us that perspective. Rate cuts on the annual as well. So how should one look at it? Where is the risk reward more balanced? What are asset classes you're looking at?
Yeah, I think it's tough at the moment. I guess a lot of people are worrying. They listened to the Fed governor's speech at Jackson Hole, and they've assumed we've got a whole bunch of interest rate cuts coming, ahead. They've begun to question that over the last day, maybe after the initial reaction. But I think probably markets are a little bit too optimistic for the rate cut expectations out of the Fed. Maybe we'll get one and then a long pause. But clearly at the moment, everybody still is focused on what Trump is doing with the Federal Reserve and clearly the balance of that particular committee with some of the actions he's taken overnight. And that is what is leading to a lot of questions from investors' minds. And, clearly if the Federal Reserve gets stacked with a bunch of, new appointees who are more prone to interest rate cuts, then that's pretty negative for the US in the medium term onwards. I think in the short term, the AI trade continues to push up, particularly US markets, Chinese markets, and continues to support global markets. But if that particular trade comes to a bit of a slowdown, then I think we could see a sell-off in certainly US stocks. I think to the benefit of emerging markets as a whole as well. There might be an initial sell-off, but certainly I think the outlook going forward on a medium-term basis looks quite positive for emerging markets and non-US markets as a whole.
Okay, thank you so much for that perspective, Jonathan. Great chatting with you as always, and thanks for coming in, speaking with us from London. Anyway, we'll switch focus. Kush still with us. Kush, how are you viewing the index and the move today? What's the take like? What should one do? Is this a buy on dips? The Nifty, the bank Nifty? Give us that perspective.
Bank Nifty it is, and I'll come to the reason for that in just a quick while. I think there's a gap to be filled on the Nifty, which comes at about 24,673. So maybe another about 100 points or so. PCR already at 0.74 and the 20-day moving average support kicking in. What this suggests is on the Nifty, at least don't go short from here on. The risk reward ratio is not favorable, and you've got multiple triggers on the downside. Now, while the structure for Bank Nifty is weak and perhaps even sell on rise, just now, just for the moment, it seems that a small token buy trade on Bank Nifty might not be such a bad idea. The reason for that is there has been this underperformance on the Bank Nifty versus the Nifty that's been going on for some time. But with today's move, it's gone deep into oversold territories. PCR has been at 0.54. This is as low as it gets, right? I mean, of course, it can get lower, but you know what I mean. It's been very, very low on some of the technical indicators. Also, Bollinger Bands also broken down. I think there could be a sharp, short covering trade that might come around in Bank Nifty. So obviously, you can't go short at these levels. But if you're feeling a little adventurous for aggressive traders on a very small quantity, you might want to consider a long trade on Bank Nifty purely for the short covering rally and keep a stop loss at the 54,000 mark. And as I said, just for the short covering rally, nothing else.
Okay, Kush, thank you. We'll leave it at that. We'll let you go on that note. Thank you so much for those views. Of course, if at all you want to pull a trade, Bank Nifty, 54,000 being the stop loss there that Kush was talking about, and only for a short covering. We'll also slip into a very short break. On the other side, we'll get you the bull versus bear. Varsha standing by already, and we'll also have the BTST. Stay with us.
Tech has changed. So should your tech show.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed. So should your tech show.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time,
Welcome back. You're watching India Market Close. If you look at the markets right now, the pressure does continue. Let's pull up Nifty 50 and Bank Nifty on the screens as well. We are below that 24,800 mark. 24,750 is where Nifty 50 is hovering at. Cuts of around 0.9% coming in there. Bank Nifty as well. 1.2% is the kind of cuts you're looking at on this front. And let's quickly look at the sectoral indices, and then we'll see the broader markets as well. In terms of individual sectors, FMCG was the one which was seeing some gains. That continues. But apart from that, everything else is under pressure. In fact, if you talk about defense, real estate, and the PSU Bank Index, they are seeing deeper cuts in today's session. Broader markets as well were pretty much in line with what the benchmarks were doing. So if you look at the mid-cap and the small-cap index, similar kind of cuts that you're seeing at the day's lowest levels. But moving on to our bull versus bear segment today, we put the spotlight on Sun Pharma. And if you talk about Sun Pharma as well, in terms of 2025 as a year, it's not been a really encouraging year for a Sun Pharma because the cuts have been to the tune of almost 15 to 16% in 2025 so far. The stock currently is also trading at the day's lowest levels. What's ailing the counter? Varsha joins us with the bull and the bear case scenario. Varsha, over to you.
Well, thank you so much for that. Sun Pharma is under pressure now. One of the reasons is because BofA has downgraded Sun Pharma. But let me start with the bull case over here, wherein the specialty portfolio, if you see, has seen a strong upliftment. But BofA has came out and they expect slower ramp up in new specialty drugs like Lexilvi and Unloxit. Now this is because Trump has yesterday said that he's going to reduce the prices of drugs from to 1500 to 1800%, and this may and because of this, Sun Pharma may have to reduce their drug prices. But this is one of the bear case that the company has. But moving on, the good case over here is that inorganic growth. So Sun Pharma will be the positive thing here is the growth will be led by inorganic growth when it comes to their dermatology and of course their oncology portfolio also. But there is a near-term headwinds and EPS cuts would be there. Now this is because of the increase in R&D cost and of course increase in the taxation part, which will hit profitability in FY26 and FY27. But the good thing over here is if you see, they are well positioned when it comes to their India formulation growth. So they're going to grow on the back of India branded formulation, which will lead to double-digit growth for the company. But the price cut in their specialty portfolio, which is Illumia, due to the US drug policy, will actually hit their EPS by 4%, and this will impact profitability and also will impact the valuation premium that Sun Pharma has got because of their specialty portfolio. Moving on, the bull case over here is when it comes to the GLP products, Sun Pharma will be first to market when it comes to their GLP product portfolio, which is on the cusp of growth. But if I want to talk about the valuation, it's currently trading at a premium valuation of 32x. If you compare it with their 10-year average, it's trading at a very high premium valuation. It's one of the reasons also why BofA has downgraded Sun Pharma. So overall, the pressure that you're seeing is because of the downgraded by BofA and also the Trump coming out and saying that he'll reduce the drug prices by 1500 to 1800%, which will have a hit on Sun Pharma's specialty portfolio, where the investor is actually betting on.
Specialty portfolio is what the investors are betting on. Thank you, Varsha, for that. Vineet, coming to you, if you have to look at a Sun Pharma with all the details that even Bank of America Merrill Lynch is looking at, with regards to the downgrade, how are you looking at us, taking the US tariffs into consideration as well? What would your view be on a Sun Pharma with the kind of correction that you're seeing today? And in this 1 year itself, the stock has lost 15 to 16%. Would you be a buyer at current levels, or would you go with the bear case scenario and say best is to stay away and look at something else from the pharma pack?
No, see, Donald Trump's tariffs are an overhang on pharmaceutical companies. And my view is to simply let the story play out on the downside and let things clarify before taking a call. I think there is no love lost in not buying these stocks at current levels.
So no love lost in not buying these stocks at current levels. Aditya Agarwala, in fact, let me welcome him as well from Invest for Edu. Aditya, welcome to the show. Your top calls for today, BTST, let's start with that.
Good afternoon. Thanks for having the show, Edel. So a couple of buy recommendations I have on my list. The first one is Hyundai. Stocks looks quite interesting. In fact, the entire auto sector is doing well. Picked up a Hyundai from that for a target of 2650 on the upside with a stop loss at 2440 on the downside. The second stock is from the FMCG space, ITC. That also seems like it's formed a near-term bottom and can see an upside from current levels. So for a target of 425 on the upside, I'll be a buyer here with a stop loss on the downside at 395.
Okay, Vineet, auto, that's been one space which has relatively done better given everything that's happened around GST. Are you constructive that space? And of course, we had Maruti as well, which unveiled its EV, which is here for export as well. What's the sense on that?
So I would tend to go with Aditya and believe that, the auto space is going to do very well, especially the EV models that are being launched. Mahindra's looks very good. We like Ola. That stock is also looking very interesting. And Maruti also should do very well because, they're launching their e-Vitara globally. And we think that the Russian market is going to be a new growth market for Indian automobile exports. Because if you've seen, they've been buying a lot of Chinese scrap, and Indian, auto stocks perform much better than their other engines out there. So we believe that a very big market is opening up there, and it's going to be positive for all auto companies.
Okay. The issue though with the market is that we're closing at the lowest point of the day. That is the worry, that we are now right at the low point with the indices 1% lower, 24,800, which was the recent swing low, completely taken out. And the banks are the one which are the leading culprit. You would have estimated otherwise, but the bank Nifty is the one which is really sulking in trade. 1.23% lower for the Nifty bank. So this is not turning out to be it's turning out to be a weak afternoon, if you will. We started off remotely okay. It's not going down very well. Aditya first and then Vineet, but Aditya, a trade maybe on the Nifty bank, a view there, because it's looking fairly wobbly today.
Afternoon, Neeraj. Absolutely. In fact, anything, it seems like it's headed slightly lower from current levels as well. So I would not hurry into going long on Bank Nifty just yet. My sense is it can slide all the way down to 54,100 to about 54,000. That's where the real supports lie. Once Bank Nifty settles around those areas, maybe one can actually look at a fresh long addition. Tomorrow being a trading holiday, I would not also like to take any position on the index, either on the long side or on the short side. See how global markets behave tomorrow and how we open day after tomorrow. It will be a better idea to take in trade once markets open fresh on Thursday, which is also an expiry day.
If that's a fair call, and we know fundamentally Vineet is not very constructive, but Vineet, this banking weakness today in particular, any specific reason, or this is market-wide correction, and because banks such a heavy weightage, they are cracking?
I think it's more got to do with, with the economy kind of slowing down. We've still not seen good follow through despite interest rate cuts. Probably, I think after September or October, once the GST GOM meets and approves it, I think we could see some pickup out there. But I think till that point in time, all across markets are going to be weak, and banks are no exception.
Okay, well, so it's looking wobbly, and if growth were to come back, let's see if the GST rates come in, and therefore does it bring back consumption and therefore the multiplier effect. But otherwise it's off. You would suspect that today is also the weakness because tomorrow is a holiday. You do not want to go into a weekend where the future is uncertain. What if something else were to happen and you're caught on the wrong foot? I would suspect that could be the other reason. So just go easy into this holiday. I just wonder though, just looking at the derivative positions, Aditya, if indeed there is some resolution between now and the time that the tariffs are to come into effect, could there be a bout of short covering? Could that be swift? Do you see that in the FNO positions as we speak?
There's no build-up as such
okay.
yet on the indices, both on the Nifty and the Bank Nifty. But yes, there could be a short squeeze for sure, because positions are very light. If you take a look at the market-wide open positions and open interest data, it's slightly on the lower side. So people are going very light into this trading holiday, and also that tariffs come into play tomorrow, sometime midnight. So my sense is people are going light. But if there is any positive news which comes tomorrow, markets could actually see a gap up open and then could build on to that position, gap up position, and market could actually then test levels of 25,000, 25,100 on the upside.
It's going to be interesting, in fact, because after the monthly expiry on Thursday, there's a possibility that markets could probably build that hope in terms of GST 2.0, which will be scheduled next week, which is between the 2nd and the 4th of September. So that could be one silver lining that one should be watching out for. But one stock that is in focus is a Nazara Technologies. The kind of downtick that it has seen in the last couple of trading sessions is now literally recovering. There is some buying interest coming back, 1.5% up move that we are seeing on the counter. Let's head across to my colleague Vansh, who's getting us all the details. Vansh, what is the reason for some bit of positive momentum that's come back?
Yeah, so what we have recently witnessed is that the real money segment has increased focus on the casual game. Because of the ban on the real money segment, we have seen an increased focus on the casual gaming segment that is coming in. Now, if I talk specifically about Nazara, now the Nazara is focusing on new IP launches like a Big Boss game in 2025 and other original IPs in 2026. So clearly there is a shift of focus in terms of IP segments in terms of Nazara. Now, if I also talk about the offline expansion for Nazara Tech, we can clearly see that the company has expanded offline by through the expected relaunch of Smash in 2027. Now, the company has announced the relaunch of Smash in FY27, and also 8 to 9 stores of Funky Monkey are also planned for this year. So, if I talk about the details of the offline expansion, now this is on the back of the strong recurring revenue streams that we can see from the offline segment, and a diversification, and this is a diversification into the non-digital segment. Now, clearly this is a diversification move by the company to diversify from the ongoing online thesis. Also, this is on the back of the brand building. Now, this is to acquire the new user across age groups. Now, the company is acquiring to, incorporate all the new age children into the ecosystem. So, moving on with this, if you also talk about the other segments of Nazara, we have Curve Games, that is a London-based video game publisher. Fusebox, again a mobile app launched by the company. We also have, followed by this, we have Kidopia and Animal Jam as the mobile games by the company. But now what's really interesting is we have Nordwin and Sportskida. Now Nordwin is Nordwin organizes esports tournament like for PUBG Mobile now, which is again a popular esport in terms of youngsters these days. Also, we have heard of Sportskida. Now this is again a digital media platform for sports. Now, if I talk about the balance sheet for Nazara Tech, now the company has 500 odd crores of cash and cash equivalents. Now, this is on the back of the cash flows and the recent fundraise which the company has done from Aksana Estates, Plutus Wealth Management and Juno Mineta Private Limited. Also, this will enhance the scope for higher user acquisition that the company can incur and for the global expansion that may be on the cards by the company. Now, if I'm moving on, let's also look at the global opportunities for this particular counter. The analysts are expecting a large opportunities in the overseas market for this company, and also the reports are indicating that they may challenge the real money gaming ban in the court. Now, if it ruled in the favor of the company, we can also see it acting as a positive catalyst for this particular counter. So overall, in terms of the picture, the company is at an interesting juncture, and where we are at the risk of the provisioning of 800 odd crores in Moonshine Technology. We can also see key drivers like new utilities, overseas opportunities, and gaming, which can drive the further uptick in this particular stock.
Okay, thank you so much for that, Vansh, coming in and bringing us that perspective with regard to where Nazara is concerned. But we've fallen 300 plus points now from the day's high, so that's pressure building on markets. While that's not evident on Nazara's stock price, that's evident on the Nifty. We're at the day's low. Shriram Finance down 4, one of those which is really taking it on the chin. Outside of that, some metal counters as well. Something like a Tata Steel is down 3. Bajaj Finance among the other lenders stroke NBFCs is also facing some bit of heat. 2.8% lower. Trent is down 2.5%. Coal India down 2% odd. But the big boys are what is really dragging the index. Something like a Reliance is down 2% as well in trade. So you're seeing pressure coming in. Let's pull up the contributors as well, and you likely see that texture play out, that the heavyweights are chipping in and contributing to the losers, and ICICI Bank sits there. And in terms of the gainers, just very, very few. We're not seeing the breadth on the Nifty 50 index to be as good, and that's what's putting pressure on the index. I want to first take a question with Vineet, and I'll go back to Nazara. Vansh obviously broke it down. Vineet, some of these gaming companies, is it a space which enthuses you? Is it a new age kind of a space which you find interesting? Give us that perspective.
So definitely, we've got one of the world's largest consumer base of youth. And, the fact that real money is out of the way, I think play, and we could see some good spends out here, and that should drive the revenues of Nazara Tech.
Okay, Aditya, anything you're seeing on charts? Because we asked Kush earlier today with regard to Nazara. He was quite bullish. Your sense?
It's a very risky bet, honestly, because we don't know what future holds and how the stocks will react. But you can allocate some money at current levels and see how the stock behaves over next 1 to 2 weeks, and then maybe take a call to whether to invest further in the stock. One interesting fact that I see, Harsh, is a lot of volume action has taken place on the correction. Once the stock had corrected, a lot of volume-backed buying has taken place in Nazara. So yesterday, if you take a look at it from lows of 1,000 odd levels, we did see a good recovery, and that was witnessed a couple of days back as well. So overall, it's not a bad stock to buy in your portfolio, but allocate a very small portion as of now and watch how the stock behaves over the next 1 to 2 weeks, and then take a call as to whether you want to build on that position further or not.
Okay, that's going to be an interesting bet in terms of whether to build a position in terms of Nazara from here on. A few of the other sectors which do come into the spotlight on the back of GST 2.0, you're talking about consumption, you're talking about the cement sector as well. Vineet, let me come to you. If you have to look at the cement counters and if you have to look at consumption, what would you bet on, taking into consideration that GST is expected to come in favor? And secondly, the way valuations are currently for FMCG as well, they're slightly below, not the most expensive.
So definitely FMCG will do well over a period of 12 to 18 months. And I think those are the stocks to go with. Cement has already seen a very good run. I expect that run to continue also. But between FMCG and cement, if I have to choose, FMCG is the way to go.
Okay, so that's with cement and FMCG. Aditya, if you have to look at cement names as well in trade today, anything that you would recommend buying?
There are a few stocks definitely here. One is Ultratech Cement, the largest cement player. I think one should stick to that name clearly. And it's more of an investment bet now, not the trading bet anymore, because of the kind of move that we've seen in the stock already. So Ultratech, yes, can be bought at current levels and on declines to levels of 12,200, 300. Look for a target of 14,000 plus on the upside. The second stock that actually looks quite interesting to me is JK Cement as well. So that is also one stock which looks quite interesting after a bit of a cool off. Stock can actually be looked at current levels, and on the upside targets can be 7,500. Not much wait for stocks to actually consolidate and correct a bit. Then maybe you can look to add more into cement names.
A couple of stocks also buzzing on the back of fundamentals. You have an Ashiana Housing up 5% on a project launch which has come through. Unichem Labs is the other one which is in focus, doing very well again on a tough day of trade. The US FDA has classified one of its facilities as voluntary action indicated, which is positive for a Unichem. Aditya, I know more fundamental, but do you have a quick technical check on any of these, because we've seen wild moves on them?
Ashiana definitely looks very interesting, Harsh. In fact, a good volume-backed move that we are witnessing in stock today after a good consolidation as well. So overall, I think one should look at buying the stock even at current levels after this kind of an up move of 4.5%. And on the downside, place a stop loss somewhere around 310 and look for a target of 370 to about 400 on the upside. Hold it. It's more of a positional bet that I think stock will give you good returns in the medium to longer term.
Okay, so that's Asiana Housing Finance, the stock nearly at the day's highest level, some cooling off happening, but 4% upside is what you're seeing currently. But staying with GST, the 3 p.m. meeting that has started, in fact, a couple of reactions are pouring in from DTRI and FIO. Sorry, this is not with regards to GST, this is more with regards to packages for the exporters. Let's get in my colleague Rishabh, who's on board to tell us what is it that he's picking up. Rishabh, we've been talking about this meeting. It's been 20 minutes into it. Some reactions coming in from the GTRI as well in terms of the quantum of exports that could go down. I think $49 to $50 billion is what they're pegging versus $86 billion to the US. What are you picking up?
Right. Some very clear-cut analysis coming on in terms of the sector-wise sector fallout that will happen once these 25% additional tariffs come in, taking India's total tariff burden to 50%. India's exports to the US, the goods merchandise will fall from about $87 billion to roughly $50 billion, and so on due to the new tariff regime that is set to come in. What we're seeing is that while about 30% of India's exports to the US will remain duty-free, these will include, of course, pharma, semiconductors, all of these exempted and electronics. All of these exempted make up about 30% of India's exports. 4% will face roughly 25%, but a bulk of India's exports, 66%, will face 50% tariff, which will render them uncompetitive versus other manufacturing economies like China, Bangladesh, Vietnam, Philippines, Indonesia, as well as Vietnam. What we're also seeing is that exports from these particular sectors, which include apparel, textiles, gems and jewelry, shrimp, carpets, and furniture, these exports now are at the risk of falling by roughly 70% to only about $18 billion. And this will, of course, put a lot of jobs at endangerment as well. What we're picking up from the Federation of Indian Exports Organizations, this is a cluster of Indian exporters, remember, all of them have also raised alarm over potential sectoral fallout that might happen post these 50% tariffs coming in. What they're saying is that a pricing disadvantage of about 30 to 35% will kick in once these tariffs come in. And this disadvantage is, again, vis-a-vis manufacturing economies like China, Vietnam, Cambodia. What we're seeing already as a result of these tariffs is the fact that you have textile manufacturers and apparel manufacturers in Tirupur, Noida, Surat, already having shut down. They're already witnessing quite a bit of a slowdown in their respective sectors. What we're also seeing is that they are calling desperately for government support. That is something that is possibly being discussed in the meeting today, an export promotion mission that is worth about 25,000 crores over a 6-year period. And that is something that we have our eyes peeled on so far.
Yep, most certainly. Something to watch out for sure. And all means that come in domestic, keep an eye out for that. Rishabh, thanks so much for getting us that. And we'll, of course, get you updates from this, the outcomes of these as and when they came in. You know, we kind of just taken trading ideas, but 6 minutes left to go. And with the way we are ending, it might be prudent to try and get see if any of the charts have worsened, or contrarian, if there are any stocks which are bucking the trend and be worth logging into. Aditya, I know we're asking too much, but because the markets have just come off even more and below 24,700 now, anything else on your list?
Nothing really. I like I mentioned, I do not want to take a lot of positions tomorrow being a trading holiday. I'm okay missing out on some kind of a gain, even if we witnessed on Thursday morning. I'll prefer looking at markets on Thursday morning and then take fresh trades.
Vineet, just before we let you go, I heard you say that you are largely, what was it, constructively cautious? Did you use that term? So let's assume if that is the case, right? You expect the markets to drift down to a particular valuation multiple where you could turn constructive, or is it that the scenario needs to change in the West before you turn constructive?
See, the scenario in the West was always going to pan out the way it is. So we have to understand that the American and the European economies are beyond repair. They don't have economies, their demographics are negative, and the debt in the US is unsustainable. So this trend was obviously going to play out either ways, right? Here we are seeing some geopolitical stunts being played by Donald Trump to ensure a better deal for his company and, make the others think also so that the US economy looks relatively better. But, for India, it's a good long-term wake-up call in the sense that, we will start looking beyond Americas, and that process has already started. And so while that would take a little bit of a while to shape out, we will see the markets correct. It's going to happen. It's going to happen not only because of the tariffs, but it's also going to happen with what is happening to the United States, interest rate increases, and subsequent valuation declines globally.
We need so much for giving us your views overall in terms of what you're expecting, taking into consideration that the markets are down, and in fact they're literally probably digesting the MSCI outflows, the US trade tariffs, and the monthly derivative expiry, which is on Thursday. But moving on, Ola is in focus as well. The PLI certifications that they've got for Gen 3 scooter, and that is what is leading to the surge. Puneet is with us to tell us more. Puneet, a quick one in terms of what's working.
Well, thank you for that. So Generation 3, which is the lower cost effectively scooter to manufacture for Ola Electric, is now compliant by PLI. That's what the company has said. Now this is very important for the company's gross margin targets, because at the end of Q1, they've said that once they get PLI for these Generation 3 scooters, they will add roughly 1.8% to their gross margins for the year of FY26. For Q1, they did about 25.1% of gross margins, with the whole year target is roughly between 35 to 40%. So while market share has been faltering for the company, they will be focusing on PLI as well as the added benefit of cells, which they had spoken to our colleague Tamanna about as well. So both these factors will be effective in lowering cost as well as increase the gross margin to 35 to 40% with the overall target of 3.2 lakh scooters to be sold. So this looks to be step one. The other aspect has to be followed up with cells to be integrated by Navratri of 2025.
Of 2025 is important for a lot of people, not only for the Ola. You're looking at the domestic oriented sectors, which will see GST benefits coming in as well. But Aditya, very quickly, do you think there could be a possibility that all the negatives that the markets are looking at could be priced in today's day of trade, and the positive developments from Modi visiting Japan, China, and the GST meet is something that markets will take into consideration? Markets could make a bottom on Thursday and start building long positions. Do you think that could be a possibility?
A possibility, yes, Hiral, but I don't think so markets will see any kind of a sharp up move as well. It's more of a range that we are trading into, and that range is likely to continue. I don't see any big bang upside move or any correction in the market either ways. And then, as you mentioned, most of it is priced in. The 50% tariff is priced into it. This was known in the market previously that it's coming. There was some hope that there could be some kind of a deal between India and US, but it didn't turn out. My sense is today's correction is just pricing into that. I don't see any major fall in the market because of that anymore. But yes, you need some kind of triggers for any upside movement as well. And that's also limited as of now. GST is also factored in. Now the rates could provide some kind of a fillip on the upside. But again, I don't see any big bang up move on the indices as well. So it's more of a sector and a stock specific market that is prevailing in the market at the moment.
Okay, excellent. Thank you for that, Aditya, for capping that off. We're down 2% now on the small cap index. We'll let you go on that note. Thank you so much for joining us and giving us those views this afternoon. Half a minute to go to close. 1% lower. We are holding 24,700 at this point. So that's probably the only positive at this level. When you're looking at the Nifty Bank, it's down around 1.3. So that's where one of the pockets of pressure is. It's also IT, which is contributing, and some of the heavyweights are also chipping in. Let's pull up the heat map, and you'll likely see that the breadth is extremely tough in this market, but you're seeing some sparks with regard to consumption playing out. ITC, Maruti, HUL, Nestle, some of those names doing okay. TCS surprisingly sitting in the green, 0.5%, despite the Nifty IT down over 0.5% in trade. So that one is a bit of an outlier. Asian Paints has closed absolutely flat as well on an otherwise weak day, so not bad. What's not doing well, some of the lenders, of course. Trent within the consumption basket is sitting in 2.5% in the red. Also, you have RIL, which is down 2%. I did speak about that. Dr. Reddy's also. So some bit of Pharma also impacted. Let's look at the sectoral heat map on your screen now. FMCG up around 0.9. So that's the one pocket which is doing okay. Auto has outperformed, but still down 0.5% odd. Realty taking a bit of a knock, 2.3% lower. Now that Realty index is below the 900 mark. The Nifty India Defence Index also down 2+%. The small cap index down 2 as well. PSU, banks, pharma in pain, evidently so. Metals too down 1.7. The private banking index is down 1.4, relatively okay, but still underperforming the Nifty Bank, which is down 1.25. So it's not looking pretty, at least as we close today. When you're looking at the advanced decline as well, largely it's just worsened, very, very likely. It has nearly 2,000 declines to just about 400 advances, so that's not looking pretty either. The Nifty mid cap and small cap, the small cap was down 2. The mid cap also down 1.5% now. At the day's low is where we've closed on the mid cap. The small cap too, very similar texture right at the day's low, 1.9% lower on the Nifty small cap. So real pressure building up. We'll have to wait and watch as to what Thursday does essentially. Let's look at the BSE 500 top gainers, top losers, and that too more tilt towards the losers. Some of the losers have slipped even more. JK Paper down 8 now, second straight day of decline on a JK Paper. Some of those stocks were showing some zing yesterday, so down 8% after what it did yesterday. Balrampur is down 6 as well. Naveen Fluorine down 5.5. So some pain evident there. The gainers far and few, but still there are a couple of them, especially within the auto space, which is standing out, and also IT, HUL also within the consumption pack. Britannia, HUL, both of those Nifty 50 plays sitting there. Now let's look at what to watch out for, and of course the key is going to be what happens with regard to tariffs, or whether any change happens with regard to tariffs. Let me put it differently, but those are some dividend related adjustments which are likely to come through, so you'll have those to look out for. Also, you will have expiry of lock-in on an Orient Tech, which is likely to happen, 53%, and you'll have IPO listing of Mangal Electricals, that's a transformers company, which is also expected to happen Thursday. So you want to watch out for some of these cues. But completely out of time on an otherwise very, very difficult day. And from all of us here, of course, wishing you and yours a very, very happy Ganesh Chaturthi and a great festive 10 days from all of us. Well, for the moment, from Neeraj, Hiral, Mahima and myself, thanks so much for watching. Stay with us here on NDTV Profit. Market Express will take the action forward.
Tech has changed. So should your tech show.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit.
Welcome viewers, you're watching Market Express and I'm your host Himakshi Bahugna, and firstly wishing you all a very happy Ganesh Chaturthi. Now let's just get started with the show. Let's see how the markets have fared today. So Indian markets slumped in trade today as Trump's tariffs on India dragged down overall sentiment. Nifty and Sensex also dropped substantially to end near their intraday lows. The Nifty lost over 250 points to end below its long maintained support level of 24,800 levels. The 30-pack Sensex also saw cuts of around 820 points to wrap up the trading below 81,000. Now, which is less than 1/4 of the listed counters ended in the favor of the bulls. Broader markets traded under a lot of pressure. The mid and small cap indices ended almost 1.5 to 2% lower. Reliance, Bharti Airtel and L&T were the biggest draggers on the Nifty, while HUL and ITC collectively uplifted the index by over 20 points. Now on the sectoral front, Defence, Realty and PSU Bank were the top laggards. FMCG was the only sector in the green today, and on the back of expectations that consumption would actually improve. An early festive season is also expected as the government eases interest rates and also cuts the GST. Although the market momentum dragged the Nifty FMCG index lower, it still ended the day about a percentage point in the green. HDFC Bank shares trade ex-bonus today ahead of the record date. Shareholders to get one bonus share for every share held. Record date falls on a public holiday, so price adjusted today. Bonus aims to reward investors and improve stock liquidity. Karur Vaishya Bank is back in the bonus spotlight with its first issue since 2018. The bank has announced a 1:5 bonus ratio, meaning shareholders will receive one bonus share for every 5 shares held. Now, this move is aimed at rewarding long-term investors, improving the liquidity in the counter and also encouraging more retail participation. So the announcement was made on 24th of July 2025, marking a strategic step to widen the shareholder base and also enhance the trading volumes. Protean eGov wins a 1,160 crore order from UIDAI to actually run the Aadhaar Kendra across 188 districts for 6 years. So the project includes enrollment updates and walk-in services. This also comes in after losing the PAN 2.0 contract despite handling PAN 1.0. FY25 sees a dip in the revenue, margins and profit. MK says the anticipated GST rate cut is delaying the auto conversions, but demand may surge 10 to 20% in quarter 3 or quarter 4. due to a nearly 7.5% on-road price drop. So dealers can claim ITC's later easing inventory concerns. However, high stock levels may dampen festive stocking, and also the cess treatment remains a key watch point. RBL Bank plans to raise up to 3,500 crore rupees through a QIP. It also seeks to borrow up to 3,000 crore rupees in debt. The board will discuss these proposals on August of 29. Now, this follows the expiry of prior approvals from August 2024. Bank of America has downgraded Sun Pharma's rating from neutral to underperform, cutting its target price from 1,730 rupees to 1,570 rupees. Now, the brokerage cites concerns over the company's specialty business, including execution risk for new launches. Now, also, the premium valuations are at risk, and the ongoing issues with its largest specialty drug, Ilumya, remain an overhang. India's stock market is pricey but justified by high returns and strong growth potential. A robust regulatory system lowers perceived risk. However, short-term slow growth and declining returns are concerns. India remains the costliest among emerging markets. Here's a look at stock calls on different sectors by Jefferies. So the oil marketing company Space First. BPCL stock fell 10% but has a solid earnings outlook. It also trades at similar valuations to HPCL despite entering a high spend phase. HPCL faces higher risk from new projects and potential tax hikes. Jefferies also prefers BPCL for its strong earnings and attractive price. Now to Jefferies on the auto sector. So auto registration rose in August with tractors up 32% and two-wheelers or trucks up 6 to 7%. Passenger vehicle sales also stayed weak, growing just 1%. Buyers are delaying purchases, expecting a GST cut to boost the demand. Jefferies favors M&M and TVS with Maruti and Eicher as next picks. Now let's move to Nomura's take on India's cement industry. The brokerage house says the industry is set for higher prices, a potential GST cut and brand upgrades by mid-tier players are also driving the price increases. West Bengal announced a hike of 11 rupees per bag, and the smaller players also struggle to hold the market share. CLSA strongly backs Avenue Supermarts, predicting a 36% stock rise. DMart leads in customer ratings and engagement. Low prices and wide product range drive its success. It excels in review quality and volume across metro and small towns. Morgan Stanley keeps an equal weight rating on Aavas Financials. The target price is cut to 1,750 rupees from 1,860 rupees. Loan growth forecasts for 2026 to 28 are lower to 16%. Slower growth leads to reduced returns and valuations. Morgan Stanley boosts target prices for HDFC Life and SBI Life. HDFC Life's target rises to 890 rupees, SBI Life's to 2,250 rupees. Now both maintain overweight ratings. ICICI Lombard's target increases to 1,910 rupees with an equal weight rating. Morgan Stanley raises HDFC AMC's target price to 5,415 rupees from 4,910 rupees. The equal weight rating remains unchanged. Asset under management forecast for 2026 to 28 are increased by 1%. The outlook reflects steady growth expectations. Morgan Stanley raises AB Capital's target price to 330 rupees from 320 rupees. The overweight rating stays unchanged. Earnings forecast for 2027 to 28 are up due to lower provisions in the NBFC business. Higher revenues and lower costs boost the HFC business outlook. BofA retains an underperform rating on Siemens, raising the target price to 2,800 rupees from 2,564 rupees. So BofA views that one round of earnings cut is done. but anticipates another due to ongoing challenges. The brokerage sees the smart infrastructure segment as overly optimistic by the street, while the digital industry segment suffers from weak private capital expenditure. Despite the valuations near long-term averages, earnings are expected to disappoint, largely due to execution issues and sluggish demand. BofA Projects Limited growth with an earnings CAGR of just 10% over FY25 to 27. This is amid the margin pressures and also the macro uncertainties. Bernstein initiated coverage on Titan Company with an outperform rating and a target price of 4,200 rupees. Titan, originally a watchmaker, has expanded into jewelry and also aims to become a global lifestyle brand. Bernstein notes the jewelry market is evolving formal contemporary styles amid the growing competition. Despite this, Titan has under-leveraged growth opportunities. A key long-term risk is the rising share of the natural diamond and lab-grown diamond dynamics, which could hurt margins on studded jewelry sales. However, Bernstein expects the near-term 1 to 2 year impact to be muted, with growth driven by product innovation and brand strength. Prime Minister Narendra Modi has inaugurated Maruti Suzuki's production line for the e-Vitara, a battery electric vehicle to be exported to 100 countries. He also launched the TDS lithium-ion battery plant, a joint venture between Toshiba, Denso and Suzuki. So the plant will manufacture lithium-ion battery cells and electrodes for hybrid EVs. PM Modi also hailed the occasion as a significant step towards India's self-reliance and green mobility goals. BlueSmart, the electric vehicle startup, is facing insolvency proceedings. Nearly 200 applicants, including Catalyst, Trusteeship and IREDA, have staked claims worth over 500 crore rupees for BlueSmart's assets. The company's co-founder, Puneet Goyal, and former executives have also filed claims. Bids for settling these claims are likely to be invited in 4 weeks. The Association of Healthcare Providers of India has reached out to the Insurance Regulatory and Development Authority of India to address several issues faced by its members. However, AHPI is currently waiting for IRDAI chairperson Ajay Seth to formally take charge before actively engaging with the regulator. AHPI plans to approach the Competition Commission of India shortly and host a summit on September 13 to discuss the ongoing concerns with insurance companies and regulators. Gamescraft has announced it won't challenge the recently enacted online gaming bill. The company has stopped all real money gaming services and cleared regulatory dues. Gamescraft is also committed to operating within the law and has initiated internal discussions to explore new opportunities. Now, this move comes after the government has passed the Promotion and Regulation of Online Gaming Bill 2025, which bans all forms of real money online games. Bihar has launched a new scheme to promote entrepreneurs' HIP among specially abled persons. Now, under this initiative, the state government will provide a 5 lakh interest-free loan and a 5 lakh subsidy. Now, this move aims to empower individuals with disabilities and enable them to start their own businesses. Mercedes-Benz Pensions Trust has sold its entire 3.8% stake in Nissan Motor for approximately $325 million, marking a complete exit from the Japanese automaker. The shares were sold at around 341 yen each, about 6% below the previous close, which led to a drop in Nissan's stock price by around 6% on the Tokyo Stock Exchange. So Mercedes-Benz stated that the stake was part of pension assets since 2016 and not strategically important, describing the sale as portfolio streamlining. Nissan is also undergoing restructuring amid tariff pressures and intense industry competition, with efforts to restore profitability underway. Apple is set to launch its 4th retail store in India, and it's coming to Pune. Located at Kopa Mall in Koregaon Park, the store will open its doors on September 4. This marks Apple's 2nd store in Maharashtra, following one in Mumbai. The new store will offer customers a chance to experience Apple's latest products and services, including the upcoming iPhone 17 series, which is expected to be unveiled on September 9. Ola Electric has received the production-linked incentive certification for its Gen 3 scooter portfolio. Now, this certification is expected to boost the company's profitability from Q2 of FY26 onwards. The PLI scheme aims to incentivize domestic manufacturing and increase India's share in global supply chains. Elon Musk's XAI filed a lawsuit against Apple and OpenAI in US federal court in Texas, accusing them of conspiring to stifle AI competition through monopolistic practices. Now, the suit claims Apple's partnership with OpenAI, embedding ChatGPT into its operating systems, unfairly excludes XAI's Grok app from App Store rankings despite high user ratings. XAI seeks billions in damages, arguing the duo locks up the market. OpenAI dismissed the action as harassment, while Apple offered no immediate comment. Musk amplified the claims on social media. Experts note that Apple's smartphone dominance bolsters the case, but it may also be seen as a business tie-up. The litigation could actually set precedent for an antitrust battle. The Enforcement Directorate conducted raids at the residence of AAP leader and former Delhi Health Minister Saurabh Bharadwaj and 12 other locations in connection with 5,590 crore alleged hospital construction scam. The investigation focuses on financial irregularities, cost overruns and delays in 24 hospital projects sanctioned during the AAP government's tenure. Despite spending 800 crore rupees, the flagship ICU hospital project is only half complete. AAP leaders claim that the case is politically motivated, while the BJP alleges widespread corruption during the AAP rule. The case originated from an ACB complaint filed in August 2024. The Supreme Court of India formed a special investigation team to probe complaints against Vantara, a zoological rescue center in Jamnagar, Gujarat, conceptualized by Anant Ambani, hearing petitions by advocate Jaya Sukhin alleging illegal animal acquisitions from India and abroad, mistreatment, financial irregularities and money laundering. A bench of justices Pankaj Mittal and P.B. Varale ordered an independent inquiry. The SIT is chaired by former Supreme Court Judge Justice J. Chelameswar, includes former Chief Justice Raghavendra Chauhan, ex-Mumbai Police Commissioner Hemant Nagrale and IRS officer Anish Gupta. Heavy rainfall has triggered landslides and mudslides in parts of Jammu, causing several roads to close. In Doda, which remains one of the most severely affected areas, a girl died after a house collapsed in Bhalesa. Almost all the rivers and streams are flowing above or close to the danger mark, submerging a number of low-lying areas and roads. President Trump has fired Federal Reserve Governor Eliza Cook, citing alleged mortgage fraud. Trump's letter on Truth Social claims Cook falsified loan applications in 2021. Cook, the first black woman on the Fed's board, denies the acquisitions and vows to fight the dismissal, calling it unlawful. Critics warn this threatens the Fed's independence. US President Donald Trump has announced that American universities will admit 6 lakh Chinese students. Now, this comes despite his administration's earlier visa policy to aggressively revoke visas for Chinese nationals. Now, the move has sparked criticism from his own supporters, with some calling Chinese students CCP spies and a threat to US opportunities. The American president, however, warned Beijing to ensure Washington access to rare earth magnets or face 200% tariffs. But he assured that trade tensions between the world's two largest economies will not affect Chinese students and they would still be allowed to study in the US. Chinese President Xi Jinping will gather more than 20 world leaders at the Regional Security Forum in China next week in a powerful show of global South solidarity in the age of Donald Trump, while also helping sanctions hit Russia pull off another diplomatic coup. Aside from Russian President Vladimir Putin, leaders from Central Asia, the Middle East, South Asia and Southeast Asia have been invited to the Shanghai Cooperation Organization Summit, that is the SCO Summit. So this will be held in the northern port city of Tianjin from August 31 to September 1st. Liverpool 16-year-old prodigy Rio Numoha made history on Monday, scoring a dramatic 100th minute winner in a 3-2 Premier League victory over Newcastle United. At 16 years and 361 days, he became Liverpool's youngest ever goal scorer and the 4th youngest in Premier League history, just 1 day older than Wayne Rooney's record. So the Nigerian-born star subbed on the 96th minute, sealed the Reds' perfect start, leaving St. James Park stunned. Indian shuttler Lakshya Sen faced a heartbreaking first-round exit at the BWF World Championships in Paris. The 24-year-old lost in straight games to world number 1 Shi Yuqi of China in a 54-minute battle at the Adidas Arena. So, despite a spirited fight and the long rallies, Lakshya Sen could not win. This marks another setback for the 2021 bronze medalist, with India's hopes now resting on PV Sindhu and HS Pranoy. Indian weightlifting star Mirabai Chanu made a sensational comeback, clinching gold in the women's 48 kg category at the Commonwealth Weightlifting Championships in Ahmedabad. The Tokyo Olympic silver medalist lifted 193 kilograms to 84 kilograms snatch and 109 kg clean and jerk, setting new Commonwealth records. Despite injury setbacks, Chanu's triumph secures a spot in the 2026 Glasgow Commonwealth Games. India's Chanabam Rishikanta Singh also won gold in the men's 60 kg, lifting 271 kilograms. Chaos erupted at the US Open as photographers sparked a 7-minute delay during Daniil Medvedev's loss to Benjamin Bonzi. Akar, who entered the court at match point, claims he was instructed by a security official and now calls the backlash a lynching, saying, "I'm a victim and totally innocent." The USTA revoked his credentials and Akar is seeking legal advice. Medvedev, who raged at the umpire's call, faces a potential fine. Well, with that, viewers, it's a wrap on this edition of Market Express, but please don't go anywhere. And once again, wishing you all a very happy Ganesh Chaturthi from the team of NDTV Profit.
Tech has changed. So should your tech show.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Street ends lower as US trade tensions weigh on Indian indices. Both the benchmarks close 1% lower. All sectoral indices except FMCG end in the red. Mid and small cap indices underperform. The Commerce Ministry, along with select key economic ministries, meet officials at the Prime Minister's office to deliberate on the implications of the additional 25% tariffs imposed by the US on Indian goods, which take effect from 9:30 a.m. tomorrow.
आज से भारत में बने इलेक्ट्रिक व्हीकल्स 100 देशों को एक्सपोर्ट किए जाएंगे।
Prime Minister Modi flags off the Maruti Suzuki's electric Grand Vitara in Gujarat, set to be exported to over 100 countries. He also inaugurates a new lithium-ion battery plant set up by Suzuki, Toshiba and Denso. Vijay Sales banks on GST rate cuts this festive season. Director Vijay Gupta projects sales growth of 15 to 20% over last year. It's an NDTV Profit exclusive. Nearly 200 applicants take claim of 500 crore rupees on Blue Smart's assets. Sources say the original petitioner, Catalyst trusteeship, accounts for nearly 250 crore of the claims. Good evening, you're watching Profit 360 on NDTV Profit and I'm Sanjana. Let's get into our top story this evening. Maruti Suzuki shares gained over 2% after Prime Minister Narendra Modi flagged off the company's first electric Grand Vitara. The automaker is positioning this as its first global EV with plans to export to more than 100 countries. The Prime Minister also inaugurated a lithium-ion battery manufacturing facility in Ahmedabad set up by Suzuki, Toshiba and Denso to support hybrid and electric vehicle production. Marking the occasion, the Prime Minister said, now EVs made in India will run in dozens of countries around the world. Let's listen in.
Make in India, make for the world. हमारे उस लक्ष्य की तरफ एक बड़ी छलांग है। आज से भारत में बने इलेक्ट्रिक व्हीकल्स 100 देशों को एक्सपोर्ट किए जाएंगे। साथ ही आज हाइब्रिड बैटरी इलेक्ट्रोड मैन्युफैक्चरिंग भी स्टार्ट हो रही है। आज का ये दिन भारत और जापान की फ्रेंडशिप को भी नया आयाम दे रहा है। साथियों, भारत के पास डेमोक्रेसी की शक्ति है और भारत के पास डेमोग्राफी का एडवांटेज है। हमारे पास स्किल्ड वर्कफोर्स का बहुत बड़ा पूल है, इसलिए कि हमारे हर पार्टनर के लिए विन विन सिचुएशन बनाता है।
Meanwhile, NDTV Profit's Danish Anand spoke to Maruti Suzuki's ED Rahul Bharti on the company's plan to service 100 markets for the sale of e-Vitara. Let's listen in.
Today you have officially entered the EV space and you're starting from exports. First of all, what is the rationale behind this decision that instead of launching the car in India first, you are focusing on exports?
See, there are about more than 100 markets that we have to service. So some sequencing has to happen. And we'll try to cover all markets, but we'll try to cover all of them within this financial year itself.
So how important is the Indian EV market for you, considering that your local competition, the other companies, they already have many EV products, and legacy player like Maruti is entering EV space after such a long time. So how do you plan to really compete with the local companies here?
Having a product is not sufficient. One, you should have an excellent product. Two, you have to back it up with after after purchase support. And Maruti Suzuki has devised an E4Me program, which gives customers a lot of confidence. If anybody is in doubt whether he should buy EVs or not, our E4Me campaign ensures that he gets total confidence and peace of mind. For example, first, of course, the product. So it's a product which is designed fresh on an EV dedicated platform. It's not an IC engine converted platform. An IC engine converted can have several design compromises, but it's freshly designed as an EV. It has several safety features like fire safety, advanced fire safety, advanced crash protection, 7 airbags as standard, and many more such features, 500 kilometers range. The performance is really good. So that's about the product. But at the same time, customers are worried about what happens. They have many apprehensions. So Maruti is here to give them total confidence. The first thing is we'll have a home charger with every car. We will have fast chargers in at least the top 100 cities of India. And while the top 100 cities account for more than 90% of sales, we will go 10x. We will cover the 1,000 cities with service support. For those service, we have trained technicians. And we are going one level deeper, and only a market leader can possibly go to that level of depth. We are covering about 130 ITIs in the country to churn out 4,000 trained service technicians who can handle high voltage products like EVs or hybrids. 4,000 every year, and at the end of that, they're free to join anybody, whether Maruti Suzuki or competition. But at least it will help increase BEV adoption in the country.
Right. So considering that there is only just one production line which is dedicated to EV manufacturing, in the months or years to come, what are your bigger plans for EVs? How do you plan to bring up and scale up the EV production in comparison to ICE?
So we have 3 production lines in Gujarat, each one of capacity 250,000. Our third line is making this e-Vitara. It is flexible to make both EVs as well as IC engine vehicles. And we will be adding a 4th line, which will be an EV dedicated line. So we have sufficient capacity.
Meanwhile, let's take a look at how the markets fared today. We saw benchmark indices falling sharply by over 1% as investor sentiment weakened after the US drafts notice on additional tariffs on Indian imports. Sensex dropped 910 points to 80,700 level, while the Nifty declined to 24,690. All sectors closed in the red, barring FMCG. But to bring us more, my colleague Puneet joining in with more details.
Well, it was a day which was under pressure for the Nifty, and we've seen that across the day today, with the advances just at roughly between 420 to 430 stocks and the declines at roughly around 1900 stocks today. We saw continuous pressure. The Nifty lost over 200 points from the day's high, and that pressure continued in the mid-cap and the small-cap index as well. For the Nifty specifically, it closed at its lowest point over the last 7 days, and barring the FMCG index, largely we saw all the other indexes being in the red today as well. Some notable stocks which were lower were Vodafone Idea as well as JK Paper. We saw some gains on stocks like IPCA as well as Craftsman Automation on the BSE 500, but that largely seems to be a day which was under pressure and continued to do so. Apart from that, we've seen Shriram Finance as well as Sun Pharma fall the most, and that was specifically for the Nifty. I mentioned Nifty fell 200 points from the day's high, but something like a Midcap 150 saw drags from Vodafone Idea as well as FACT as well. The Midcap 150 has fallen for the 4th consecutive day, and there seems to be any kind of lack essentially of a particular trigger to boost the markets going forward. Apart from that, we also saw the small cap 250 fall nearly 2%, and that was led by Swan Energy, Balrampur Chini Mills, amongst some of the key stocks that impacted the small cap index today. Finally, in terms of sectors, we've seen the realty index largely, along with the PSU bank and oil, have the major essentially drag on the Nifty, while we've seen that all sectoral indices largely continued to be under pressure throughout the day as well. The Nifty FMCG was the only one which offered some kind of solace, up 1% in trade today. We saw some positive gains on stocks like Britannia and as well as something like an HUL, but that largely seems to be one of the key aspects of a continuous pressure that we've seen across the market, and we'll be hoping of some positive start on Thursday morning, with tomorrow being a market holiday. So very happy Ganesh Chaturthi to all of you.
And meanwhile, plenty of primary market action today as 4 companies made their market debut. Shriji Shipping, Gem Aromatics, Vikram Solar and Patel Retail all listed on the bourses. Anushi now joining us with more details.
4 new IPOs which have listed today. Firstly, I'll start off with Vikram Solar. Now, this is amongst the largest renewable energy space players that we are looking at, with a production capacity of 4.5 gigawatts. Now, total size of this one was about 2,079 crore with a fresh issue component of 1,500 crore. As if we saw that the IPO had received decent subscription of around 56 times. So this was in focus. Along with that, something which clocked in strong gains today was Patel Retail. Now, if you look at this company, this is a supermart chain with about 43 outlets across suburban Maharashtra and under the brand Patel's R Mart. Now, this total size of this one was 243 crore. IPO consisted of 217 crore of a fresh issue size and was subscribed about 96 times at the end of day 3. Gem Aromatics, also another one in focus, Mumbai-based manufacturer of essential oils, aroma chemicals and other specialty ingredients as well. This was a relatively smaller one with a 451 crore of a total issue size with a fresh issue component of 175 crore. This one had also received a 30 times of an IPO subscription level. So all these 3 that we've seen have received decent subscription numbers as far as we've seen. The last one is Shriji Shipping Global. Now, this majorly operates on the west coast of India, focusing on non-major ports and coastal trade. IPO proceeds of PC will majorly go towards buying dry bulk carriers in the Supramax category. If you are looking at, total size of this one was 411 crore, and this included this is a total fresh issue of that we are seeing about 410.7 crore, with IPO receiving about 58 times the subscription that we are seeing. So these are the 4 listings in focus today.
Thanks for that, Anushi. And moving on, according to a report by the Global Trade Research Initiative, the US's new 50% tariff regime is set to hit India's exports hard. The move is expected to weigh most on labor-intensive sectors like textiles, gems, jewelry, shrimp, carpets and furniture, making them less competitive against global peers. My colleague Rishabh now joining us with more details from GTRI and FIO's statements and the latest on the Prime Minister's office deliberations. Rishabh, what are you hearing?
Right. What we're picking up is that a meeting is underway between the PMO as well as key economic ministries, including the Commerce Ministry. What we're hearing is that talks will revolve around the status of India's
Right, we seem to be having some connection troubles with Rishabh. We'll try and get back to him in just a moment, but this is the latest that's coming in right now. This is a report that has come out by the Global Trade Research Initiative saying that the US's new 50% tariff regime will hit India's exports hard. We're looking at most amount of impact in labor-intensive sectors like textiles, like gems, jewelry, carpets and furniture, making them less competitive. Let's just move on now, and we'll try and get back to Rishabh in just a moment. But the deadline for the potential 50% tariff from the US is set to expire tomorrow. But to understand the gravity of the situation, we also spoke to several prominent figures, including the President of Seafood Exporters Association of India, the Vice President of FIO, the President of the Textile Association of India, and the Chief Economist at Yes Bank. My colleague Hiral asked them about the ongoing uncertainty, especially given the initial anticipation of a 21-day negotiation window. Let's listen in from this insightful discussion.
we're not really changing our GDP numbers yet. Because I think the critical issue is, yes, the tariff takes hold, but on the other side we also have a GST regime that is coming on. So we are talking about two different segments of the economy, one being very significantly negatively affected, which is the export segment, and the downside implication of that on employment in the country, because most of the exports to the US that we are talking about is also labor intensive exports. So there is a downside implication in terms of the employment as well as the purchasing power of the population. But on the other side, we are likely to neutralize that to a certain extent by the GST regime. So it's a very difficult story at this point in time, and there are two diverging sort of pulls that are present in the economy on the growth side. And from that perspective, we have still not altered our headline GDP number, though some of the internal numbers may actually be changing. The other important issue is that while the GST positively impacts from a price perspective the services sector, we still don't have tariffs on the services sector. And that restricts itself to the goods sector. So that should be another enabler in terms of the headline GDP number that we look at. In terms of the overall hit purely from the tariff, we are estimating a 0.2 to 0.4% sort of hit, depending on about a 20% sort of exports to the US from India being critically impacted. That's the first round hit that we are estimating.
0.2 to 0.4% in terms of GDP hit, Mr. Pan, is basis 25% tariffs, so you're saying basis 50% tariffs?
So it's basis the 25% tariff. It's very difficult to assess what happens in terms of the 50% tariff. I think other guests on your panel will be more sort of suitable to answer this particular question. So at 25% tariff, what I've heard from exporters is that they'll possibly be able to absorb a certain bit, and they would not really cancelling orders. But the situation may drastically change with the 50% tariff, and therefore I would expect other guests on your show to actually sort of pin down in terms of the sectoral perspective how it impacts the overall performance of the sector.
Absolutely. So that's going to be more important. In fact, let me also get in Ravikant Kapoor, Vice President for you. Ravikant, welcome to the show. My question coming to you is, negotiations have been going on. You have, as an association, you have been in touch with the Commerce Ministry as well. What is it that you're picking up now from an impact perspective, representing the exporters? Do you think there is a way forward from here on?
There's always a way forward. But I believe that we have to take it one by one. We have to look at the current situation as it is. It is really a major disaster for exporters to the US. It's still a fresh wound. The pain will set in. It will take some days and weeks, probably some months, if they do not come to any settlement. And for the exporters, we do not see any alternative, especially the ones who are levied the 50% reciprocal plus the earlier normal duties. It is something that we have to now look at: damage containment, hand-holding by the government. The first thing that's going to hit you is what do you do with all your inventories? What do you do with your documents which are of goods on the high seas? It's going to lead into a kind of a financial situation where a moratorium will definitely be called for and should be done within a day, because people need to know what they are going to do. It's also going to affect employment in a big way, because the ones that are paying duty are apparel, they are leather, they are carpets, they are shoes and chemicals. So these are the ones where there are big employment running into crores of people. So how are they going to be managing it? And a lot of this is going to the US, which has been a primary market.
Meanwhile, the Communications Ministry has sought an extension on America's postal duty order as India Post is facing technical and operational issues. This is ahead of the order by the US scrapping duty-free parcels valued up to $800. The request has been placed with the Commerce Ministry and the MEA. My colleague Aishwarya Patil now joining me on the phone line with exclusive story details and more details on this. Aishwarya, over to you.
Well, as you rightly mentioned, the US did pass an executive order which earlier had exempted up to $800 of duty-free allowance. Now, what the Communication Ministry has done is requested the Ministry of Commerce as well as Ministry of External Affairs to extend the implementation time of this US Postal Service executive order. Now, India Post is saying that in order to streamline the operations and also to ensure technical readiness, that is the reason why they need an extension for all of this. Essentially, what the executive order does is that all of these parcels that are being sent to the US under $800 or so will now not be able to be processed by a lot of these airlines as well, because what they're asking of the airlines is to collect duty on behalf of the US government and then get these parcels to the US. And airlines such as Air India, Lufthansa Cargo, Swiss Cargo are all unwilling and do not have the systems, as they say, to collect the duty for US bound emails as well. Of course, a little bit of a background, if you will, on this order is that it was effective. The order came through and it is effective. It will be effective from August 29, 2025 for all countries, including India. India Post has already suspended all the parcels from the 25th of August going forward to the US. Only letters and documents or gift items under $100 will continue to be accepted going forward from here. So that's the story so far. We'll keep you updated as and when we hear on the developments further from the ministry sides as well.
Right, Aishwarya, thank you so much for that update. The Communications Ministry seeking this extension will continue tracking these key developments and bring you all of the details. Moving on, Vijay Sales is betting big on the festive demand and GST rate cuts. Director Nilesh Gupta told NDTV Profit that he expects sales growth of 15 to 20% during the festive season this year over the last. Here's a snippet on how the retailer is gearing up for celebrations.
Today, we are at a very special location. We are at Vijay Sales store talking about the new GST reforms and the boost in consumption that is to follow, and of course the festive demand and how are the sales looking like. And to discuss as to how things are faring at Vijay Sales, we are joined by Nilesh Gupta, who's the director at Vijay Sales, joining us now. Always a pleasure speaking with you, Mr. Gupta.
Thank you for having me here.
My first question to you is that, I want to understand that with regards to this new GST reform that we're talking about, where GST will come from 28 to that 18% mark for ACs, plus your 32 plus inches TVs as well as dishwashers. How is the industry viewing this and how is this move being welcomed by the industry?
So I think the industry is viewing this as a Diwali gift by the government. Definitely, both the categories are very important.
Yeah.
The 32 plus televisions as well as the air conditioners.
Right.
And especially in the light of the air conditioning summer season not doing so well because of the rains, erratic rains, I think this is going to be a real breather for us and it will definitely boost the sales.
In terms of the overall view as well, from a Vijay Sales point of view, from a retailer point of view, how do you think that this consumption boost, it's not just GST alone. There's lots happening that the government is in fact doing to boost the consumption, right? There was income tax cut, there was also rate cuts that's come in, there's 8th pay that's going to come in, plus this new GST reform. Lots, done by the government to boost the consumption. How do you think this will incrementally benefit Vijay Sales? If you can give us a perspective in terms of percentage as to what growth can come in from this consumption boost.
So what we are seeing is already the income tax rate cuts which were announced in the finance budget has translated into extraordinary sales for us. So the sales have gone up and we are already seeing, in spite of a poor summer, we are already seeing a growth of around 10 to 12%, which otherwise would not have been possible. And now with this GST cut coming in, the positivity all around happening in the country and the very fact that we are able to stand on our own irrespective of what's happening outside, I think it's a very positive impact. And in consumer durables especially, what matters most is not whether the consumer has money or not, but what matters is sentiments. So right now the consumer sentiment is up, plus he has money in the pocket. So it's a double whammy. So we expect a real good sales to begin once the GST sets in.
And that's all the time we had on this edition of Profit 360. But before we go, on the eve of Ganesh Chaturthi, leaving you with some lovely snapshots as the state of Maharashtra gears up for the festivities.
Tech has changed, so should your tech show.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold ICICI for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed, so should your tech show.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold ICICI for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company? Hello and welcome. You're watching KYC. I'm Harsh Saita. With me is Puneet Javeri, and we're going to today talk about an auto company which is guiding for 20% sustainable growth, or rather, let me change that a bit, tweak that a bit. They're talking about 2x the growth of their industry, and it's on a very small base. They're tapping into export as well. So all of that likely to aid the numbers overall. But let me start off with what I want to know with regard to SJS Enterprises. Very, very strong clip of growth is what they're guiding for. I want to know whether they're doing the 20% sustainably is what one can expect over the next 5 years. The second piece is with regard to Walter Pack. Now this has been, this acquisition has dragged the business a little bit where Q1 FY26 is concerned. I want to know, and that's because of client concentration. I want to know whether that can turn a corner and how quickly can it do that. The third piece is with regard to client concentration. Is there a thought process within the company to acknowledge that and to change that is what I'd want to understand. Fourth one is with regard to margins. They do 26% margins, so high growth clip plus high margin plus a unique business. It meets all of those parameters. I want to understand whether those margins can be maintained and what the downside risk could that well be. Fifth piece is with regard to growth. Where will it come from? Current client cohort or a change in product mix, or a little bit of both? I'd want to try and understand some of those levers. Sixth piece is with regard to competition and moats. And I'm rushing through this because we've already done the interview. It's a long one and we want to make sure that you listen to the entire interview. So that's the sixth piece. The seventh piece is with regard to CAPEX and revenue visibility. How much of CAPEX is getting penciled in and how much can the top line go to given this CAPEX? So no future CAPEX till what point in terms of top line? All of that and more on KYC today. Let me start off with about the company. What it does, it designs, develops, manufactures decorative parts for vehicles and appliances. I'm going to quickly tell you briefly what it means. Your car dashboard, on it there is of course the speedometer. They manufacture that part of the car. They manufacture the glass on top of it. So all of those parts. Your steering wheel has the logo of the car on it. So does your two-wheeler, and therefore all of that is what they typically manufacture. Logos, overlays, dials, all of these. And it's a fast evolving business, because if you see some of the new age cars which are coming through, and some of the more expensive ones, the higher ticket ones, they have digital logos as well. So all of that is what they've pivoted to. In terms of product categories, that's quickly coming up on your screen. It has decals, graphics, 2D dials, 3D dials, which is typically a display on the car, and the branding on the vehicle. Domes and 3D badges, overlays, which is typically your logos, different types of logos both in 3D as well as in 2D, aluminium badges and in mold parts, which is high quality, durable branded parts within a vehicle on the appliances of the vehicle, giving it its nice shape, or the branding inside the car. All of that is taken care of. Optical plastics and cover glass, which is lots of glasses all around the car as well as on your other appliances. I'm restricting this to cars, but they also do other appliances, and that's a fast growing piece. So for example, your two-wheeler, on top of the dial you'll have the glass, which is what some of this is. The lens mask is typically the mask on top of, say for example, your headlight on the car or the bike. The mask on top of it, which is a transparent plastic mask, is also manufactured by them. Chrome plated, painted parts on the exteriors, handles, etc. All of that is taken care of by them. The aftermarket transformation. Now, this is a large market. We've come to acknowledge it, and the aftermarket there are a lot of customers looking to transform their vehicles, make it look newer, jazzier, cooler. All of that is taken care of by them, and illuminated logos. I did speak about that. The revenue mix quickly coming up on your screen. Two-wheelers is around 39%, currently was at 34% in FY25. Passenger vehicles around the 37 to 40% number. Consumer is around 18 to 20%, and others is around 6% odd. That's the broad breakup of the revenue. The geographic mix, currently domestic is around 92 odd percent, with exports of around 8%. Exports expected to double in terms of overall mix in the next few years is what they're targeting. They're targeting a 15% export number very, very quickly. Now let me allow Puneet to start off with the income statement in terms of the metrics.
Well, definitely. It's been a very strong performance by the company over the last 3 to 4 years. From FY22, the revenue has grown at 27% CAGR, and that's passed on to the margins as well. Over 26 to 27% is what they've done in this particular time frame. Profits subsequently have grown at 28%. So this acoustic as well as aesthetic products that they manufacture for automobiles has been working very well, essentially with the premiumization of this particular space, and that's visible in the company's numbers as well. So there's no doubt it is a big thumbs up given on this particular metric. Balance sheet, Harsh.
So equity quite decent in terms of its size, 680 crore, fast growing because it's extremely profitable in the sense it's got a strong profitability. Also, it's trading at around 6 times book value, so something to be taken care of, but very, very low to no borrowing. Your cash bank balance is also decent. There's some capex in the pipeline. We'll speak about that with the management. Cash flow, Puneet.
Well, again, cash flow, we spoke about the profits that subsequently almost doubled in the last 3 years. The cash flow from operations also has gone from 87 crore all the way up to 163 crores in FY25. We've seen the cash flow to profitability or ratio as well on your screen right now doing very well, while net cash flow, while lower, has been lower because of the investments that they've done over the last few years. They've also done roughly about 45 crores of capex. They're expecting to do that in FY26, but that largely seems to be investing for the future. So we've given this a thumbs up as well based on the company's future outlook, as well as the efficiency with investments, which is showcasing in the numbers as well.
Excellent. Let's talk about return ratios, and you see that above the 20% mark, no questions asked, and therefore a thumbs up. It's a sustainable 20% given that there is some bit of confidence with regard to margins, and if that continues, top line growth, margins, well, no reason why this should not be sustainable. Shareholding, Puneet.
Now, shareholding has largely been stable from the promoter family. We've seen from roughly about March of 24 when they've held 21.8% stake. We've just seen in the previous year that private equity firm Everstone had actually sold roughly 29 to 30% of their shareholding. So you see the promoter holding has actually gone down from 50% to 21%, but that's largely the exit of the private equity investor. Promoter family continues to have confidence in the business. We've also seen subsequently this selling by the PE fund lapped up by foreign investors. Roughly from 5%, they've gone to 17% in terms of their shareholding, while the investors, roughly 1/3, remains with the general public as well. So keeping an eye on these niche businesses has been one of the key aspects of individual investors, and that seems to be visible in the numbers as well.
Street cred, you look at a 12% 1 month return, 60% 6 months, year to date is 21%, and 1 year is 38%. Since November 2021, since listing, it's a 3-bagger for investors. Clearly a thumbs up, no concerns here. Puneet, I'll allow you to take both valuations and coverage.
Well, let's start with street coverage first. It has 8 buy calls and none of them are hold. The other key aspect is that currently, out of the 8, we've picked out a few brokerages like JM Financial, Elara, as well as IFL. These were some of the ones which were very well known to the street as well. All of these have a very positive outlook on the company. Roughly the target price ranging from 1400 all the way up to 1700. For Elara, they've actually raised that post Q1 earnings as well, which was in the end of July. So it is a positive outlook on the company, and you'll hear from them as well. In terms of valuation, while there is not so much comparison available in terms of listed players, because the company also mentions that this is a very wide industry. A lot of players do a lot of smaller aspects of the business, but with SJS largely organizing it and getting it under one umbrella, that seems to be one of the company's moats, and currently trading at over 34 to 35 times price to earnings. For FY26, based on the coverage from the analysts, it trades at roughly around 28 to 29 times price to earnings. And while there are much more established players amongst the auto ancillary space that trade at similar valuation, the lack of any one particular company with this kind of segments as well as granularity seems to be why Street is giving this kind of valuation to a company sub 5,000 crores in terms of market cap. But hence we've given this a neutral on that aspect, but it's definitely positive on the growth the company is projecting.
Excellent. Let's therefore stack up all of the rating parameters, and it gives us a very, very healthy 6.5 out of 8 on our KYC ratings. We spoke with Sanjay Thapar, both Puneet and myself, the Group CEO and ED at SJS Enterprises, listening to that entire conversation. So you've guided for very strong growth. FY26, yes, you've given that guidance of 20%. So I'm trying to understand a slightly more long-term perspective here. For how long can you continue to grow at this kind of clip? Because as your base grows as well, and you're growing at nearly twice the industry, can you continue to clock this 20% kind of growth clip is what I want to understand first off.
Let me put this a little bit in perspective. So the global market for aesthetic decorative products is close to about $4.7 billion. And at SJS, we've historically, over the last 3 years, we have a revenue CAGR of close to 27.2%, which means that we've outperformed the underlying industry by a factor of 2x or more than 2x actually. The industry in the same period has grown just 10.5% if I combine the volumes of two-wheelers and four-wheelers put together. So we are quite hopeful that because of the trend of premiumization, our focus on new products and new technologies, which are higher in value and higher in value add, we will continue to grow around the same clip. So that's what my expectation is.
Oh, so would 5 years be the right kind of view or visibility to take in terms of this 20% growth guidance? Can we pencil in that next 5 years at least the 20% growth clip will continue at the very least?
We don't guide in terms of percentages. So what we say is that there's an underlying industry that we will outperform. So our guidance for the current year was that we will be 2x of the industry growth, and we'll continue doing that. So think of us as a high growth, high profit company, which is still tapping the opportunity set globally. So we've positioned ourselves as a global supplier, and we are very excited about the opportunities that lie ahead of us.
Mr. Thapar, very good morning to you. Thanks so much for joining in. It's Puneet this side. We spoke recently post our Q1 earnings as well, and largely you seem to be quite positive with the acquisition of Voltapack as well as your consumer business as well. Given that you are outperforming the industry, roughly at about 760 odd crores for FY25 in terms of revenue, could we anticipate that this could lead to almost doubling in the next 3 to 4 years, given the new products that you integrated are still to see a bigger impact in your existing businesses? So could that be a fair assumption given the strong margin profile as well?
I think that's a fair assumption. So I'd be disappointed personally if we don't double our sales in that period of time. So yes, directionally, you are absolutely right.
And Mr. Thapar, essentially in terms of growth, it's quite obvious that you are outperforming the industry. Just talk a little bit about Voltapack as well as the consumer business, because your auto business is growing at a fair click, and that's well known. With chrome plasting as well as something that you've spoken about is a very big business, as well as with the export opportunity. Which business do you think will lead the growth for you specifically? Is it these two new verticals that you expect? And what is the expectation of some that you can quantify for the consumer business as well? What can we look at?
Look, the way we look at ourselves in terms of a growth opportunity is through the lens of the customer. So what does the customer want from a global supplier? He wants a company that can offer him the best-in-class products at a cost that is very competitive and with no delivery hiccups. So over the years, we've proven a supply chain capability. I export to more than 220 locations across 22 countries, whether it was COVID, whether it was the container blockage. So we've earned that trust. So that makes us very confident that we are a company who's recognized by marquee OEMs across segments, whether it is automotive, whether it is consumer. So we've grown well, and we have a track record of growing large mega accounts. Coming back to Walter Pack, so I think that is a game changer as far as us. So we've, with that acquisition, created a capability set that we lacked at SGS, both in terms of tooling for complex in-mold formed parts, also some specialized know-how in terms of 2K molding, and that is a carrier. Think of it as a force multiplier for SGS, because we have a very strong printing background, printing on different substrates. And with this acquisition, we've actually, what we've done is we've created a very niche set of components. And Walter Pack is one of the very few suppliers, Walter Pack Spain I talk of, is one of the very few suppliers globally in this area of in-mold formed decoration parts. And with this acquisition, I think we are at the forefront in terms of technology. These are expensive parts, but we see the trend of premiumization that happens in India. So typically you launch high-end expensive parts in premium top-end segment of vehicles. Slowly customer demand for such aesthetics percolates down to the mid segment and the entry segment. And we see the market growing very rapidly once that happens. So we are, I think, strategically in a very good position as far as Walter Pack goes, both in terms of technology. This is a long lead item because tooling is very complex. It takes close to about 8-9 months to make a tool. So I would say in the period of 4-5 years, you should see significant contribution coming from the in-mold form parts. We see a lot of demand for chrome plating, especially in the export markets. So we could possibly see a lot of business growth in that area as well. And largely to say, what are the growth drivers? So four-wheelers as a business segment will grow very rapidly for us, as will consumer businesses, thanks to the new technologies that we are launching.
Mr. Thapar, on Walter Pack, Q1 was a slightly softer quarter. When do you start to see recovery there? Of course, reasons well known. There's some bit of drag coming in with regard to clients. When do you see a recovery there in terms of your top line? And what does Walter Pack do to your margins? Are you able to maintain that 25-26% kind of margin number?
I think we've proven that. So historically, we've maintained margins north of 25%. So 25-26% is what historically we've delivered. Maybe 3 years or 5 years now, and after the acquisition of Walter Pack as well. So I think the truth lies in the numbers. So Walter Pack is an important component to our overall strategy. Where do we see? So since this was an acquired business, there's a legacy set of customers that we have. So as a company, we de-risk ourselves by saying we should not be too dependent on one single customer. So in fact, consolidated basis, no customer constitutes more than 15% of my top line. But that is not true for these subsidiaries that we have. These are basically acquisitions. So there is a legacy set of customers. So we are fast gaining traction with other customers as well. And I expect that balance of customer concentration should also reduce over time. And we already have good visibility for orders that are coming in. But as I said earlier, Walter Pack parts are large in-mold form parts which require tooling time. So I would imagine that over the next 1 year or so, we should see Walter Pack coming back and it being a more diversified play, reducing the customer concentration that we currently have.
Mr. Thapar, one question on your kit value specifically, because we've spoken about this in the past. You were at somewhere around 1,200 to 1,500 for passenger vehicles. You've now gone to roughly between 4,000 to 5,000 post Walter Pack's acquisition. Now, you've had some huge guidance. You're mentioning that this will double in the next 3 to 4 years. Could you specify if this will be done via new products like cover glass amongst others? Or will this be with increasing your current business with your current clients, the top 7 to 8 that you cater to? So where should the growth come from?
So growth comes from both these areas that you mentioned. So yes, displays continue to be a very strong opportunity set. SGS is well poised to address this market because of our inherent nature of the products that we've done for a number of years. So aesthetic parts and cover glass is also an aesthetic part that requires printing. And we are in the process of examining what more can we do in the cover glass business. So we don't want to restrict ourselves to cover glass. The overall displays as a category is very interesting for us, and we are positioning ourselves to address that market. The kit value that you mentioned, you're right, from 5,500 odd rupees potentially per four-wheeler, it is likely to go up to 10,000 per vehicle over the next 3 to 4 years. And SGS is, I think, strategically absolutely in the right direction.
And Mr. Thapar, just a follow-up, what would be, the kind of addition that you think that cover glass could do to your products? Is it one of the most game-changing aspects? Because it seems to be that your current products are adding a lot of value, but this one is a high, the price of that per vehicle is also high and the margins are also better. So what kind of addition do you think that could get you?
So my guidance really is that we continue adding new products. So cover glass is one, in-molded electronics is another area that we are working on. So all these are new technologies. At the moment, there's nobody who makes cover glass in India. So as we move forward, I think we will have an early mover advantage, and they will continue to deliver revenues for us. But our revenue growth, even in the other lines of businesses, are very strong. So we have a great opportunity for cross-selling. So every time that I order new customer, I have maybe 40 different product technologies that I can offer to them. So our ramp up is pretty rapid. And every time that we acquire a new customer location, so there's a lot of opportunity for growth. So where the growth will come from will be both. This cover glass business and display-related businesses will grow, as will our other product lines that we've created over the past years. So it's a secular growth. But as I said earlier, automotive four-wheelers are likely to drive growth because they're larger products and larger cover glass, larger everything. So both interior and exterior. So that's a great area that we've pivoted to. So maybe 5-6 years ago in 2019, 70% of my sales came from two-wheelers, which we've successfully transformed, and now it's equal weight. So maybe 35-36% from two-wheelers and 35-36% from four-wheelers. So I think I'm quite happy with the way we've been able to pivot the company.
So where does this go in the next 3 years? Do you continue to add product lines, and therefore that will not only expand your market share within this segment, but also allow you to capture market share in other segments? Is that how one should think of SGS?
Yeah, our products are fairly agnostic to the end use. So typically if you have a treadmill, that requires overlay we make. So those are the markets that we've not addressed yet. But growth will come across all segments. So it's hard to call out any one area, but broadly, appliances and four-wheelers will drive growth for us, especially in the export markets. India, of course, we continue to retain our position and consolidate our market position.
Mr. Thapar, just one final question from my side. Essentially for two-wheelers as well, you mentioned that the share has gone down from roughly 70% in 2019. You are adding new clients. You've added Hero in the last couple of quarters. Could you just give us some sense of the competitive intensity in this space? Because it's a high volume product. We're also expecting some kind of cost increases because of ABS. So what does that do for you, for example, in terms of the cost increasing essentially? So what is the current conversation that you're having with clients, and who are you actually competing with? Because for the first time you've gotten Hero, and Hero sells over 50 lakh motorbikes. So just some sense on that sense as well.
No, so let me correct you. Our two-wheeler business has not come down. It has increased.
The share of course, four-wheelers has also increased. Understood, sir. The overall revenue.
Businesses have grown tremendously, so therefore that weight has come down. So that's the point. Yes, we are very optimistic about Hero, so that's a good addition to our portfolio. And we continue to develop new models for them. And as I've stated earlier, we would potentially look to consolidate and gain a significant market share with that, as is our endeavor with all customers. So Coming back to ABS does not impact us really because what we do are PVC films and special materials for their logos. So there is not much of a challenge in terms of ABS because we don't do plain vanilla molding. You know, the business that we are in is high value add decorative products that are long lasting. And that is what is our DNA as a company. And that translates into, it's a very complex business, batch mode operation. So competition intensity is extremely difficult. So there is, I don't know of a single company in India or overseas which has as many products as I have in my portfolio. So we have close to about 14 different technologies. And most of the competitors that we have focus on just one or two. And I think what helps us with that is to position ourselves as the supplier to go to when a designer looks at improving aesthetics in a vehicle. So they're happy to do that. We have a styling studio which designers come and work along with our designers to formulate specs. And we do this pro bono. So we also have rapid prototyping capability. So we supply products with a very short turnaround time, and that I think engages us even more deeply with our customers.
Well, he also spoke about CapEx, and he said that CapEx, which is in the pipeline over the next 2 years, will take their top line from the current sub 800 crore to 1400 crore nearly. So that's broadly the guidance. But, that's all the time we have from Puneet, myself, and everyone who puts this show together. Thanks so much for watching. Hope you found it productive. Of course, stay with us on NDTV Profit.
Tech has changed, so should your tech show.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold ICICI CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed, so should your tech show.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold ICICI CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in?
Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Today, it's all about calculations. On the one hand, we're going to talk about how you should pay back your loans. When is it beneficial for you to prepay your loans? And what is the order that you should consider prepaying your loans or getting rid of your loans if you are paying different rates of interest? That is, if you have a personal loan and a home loan or some other type of loan. There are a few strategies that you can employ. And the second part of this conversation is a very interesting calculation which actually might throw up a situation where you can earn more on an EPF in your employee provident fund than you could earn in equity post-tax. I know that it's not a like-to-like comparison, but still it's an interesting calculation to consider and to look at. But first, let's talk about loans. And joining me on the first part of this conversation is Mrin Agarwal, who's a financial educator and founder of FinSafe India. Mrin, thanks so much for taking the time. First up, let me ask you this. From a prudent financial planning perspective, how much loan is okay? And how much should your EMI be as a percentage of your take home?
Good evening, Alex, and nice to be here today. Well, from a prudent financial planning perspective, the EMI as a proportion of your take home needs to be limited to 30%. And, you know, the strange thing is that I see a lot of people who are at this 50-70% of their take home going towards EMIs. That's just too high. You're just living your life in debt. So I think smart way of borrowing is to keep your EMIs limited to 30% of your take home. And this is all your EMIs. It could be a home loan, personal loan, car loan, whatever it is, total EMI does not exceed 30%.
As much as the prudence makes a lot of sense, I think, and a lot of young people, Mrin, are buying into this idea of prudence, and they want to live their lives on their own terms. But the old situation was that you start earning, you work towards buying a home. And unfortunately, the reality of it is that places like Mumbai, places like even Bengaluru now, places like Pune, real estate, New Delhi, real estate is getting so much costlier than it was even 5 years back, that buying a home is incredibly difficult. And so the argument that people make is that in the initial years when they're earning slightly less, they can stretch a little bit, and when their earnings go up, then automatically as a percentage of their take home, the percentage goes down. Is that the right approach in your opinion?
Yes and no, you know, because finally I always say that, you know, we can do all these calculations on Excel, you know, but then if you're not happy about it and it's feeling very bad and it's affecting you, then obviously you should do what you want to. But, you know, the issue in doing the stretch is that, you know, you kind of get attuned to living your life on that stretch. And that's what we are seeing today, right? Like we're seeing such a high incidence of loans when you look at the whole household debt, right? So I think the issue, what happens is that you get used to living on that particular stretch, and then like bringing it down to the 30% is a little tough. So I would actually say wait it out for some time. And, of course, there's this whole buy versus rent argument that is there to say that why buy at all, just stay on rent. So I would say enjoy your life on rent when you're young, and when you can really afford it, then look at buying that house.
Yeah, it makes a lot of sense, which is not to say that you should never buy. You should absolutely buy, because when you stop earning, that is a security that you will have. But then absolutely buy into that philosophy. But what if you have a home loan? And this comes to the first calculation that you've shared with me. Can you take me through it? Because you've assumed a loan amount of 80 lakhs, which I think is normal in a city like Mumbai. You can't get away with not taking a large loan. And I'm glad that you've taken a slightly larger loan, because I think a lot more people can relate to this then. The tenure is 20 years and the interest is 8%, which again is a pretty normal amount if you consider the longer term, right? You might be able to get it less right now because the interest rates are lower, but then the average cost will be that much. So how do you work out something like this? What are the strategies that you would employ?
Yeah, so this was more, because I get a lot of questions from people saying that I just received my bonus, or I've just got some extra money, and should I prepay or should I invest? Because what happens is that, typically one thinks of it like this, that my loan is at 8%, and what I can maybe generate from my investments, especially if it is in equities, is going to be between 10 to 12%. So then, the question then remains that why should I prepay the money? Why don't I just go ahead and invest? So we'll take this, I'll give you the answer in two parts. So the first part of it is really in terms of what happens if you do a repayment. So let's say that, in this particular case, you have some extra amount of money and you're prepaying 1 lakh rupees every year, right? So what happens due to that is that you, of course, save a lot on the interest. So versus the 80.5 lakh rupees as interest, you're almost saving around 17.5 lakhs as interest. The bigger aspect is that your loan tenor is falling from 20 years to almost 16 years, right? So you're repaying your loan 4 years earlier, right? So that is if you do the prepayment every year. Now, if you say, no, I don't want to do the prepayment, I want to go ahead and I want to invest this money every month. So, assuming a 12% return, in 20 years, that amount, the 1 lakh rupees invested annually every year, will lead you to about 76 lakhs, right? Now, this is where the numbers are concerned. So what you're weighing for yourself is, do I want to prepay my loan 4 years earlier and save on 17 lakhs interest, or do I want to have 76 lakhs wealth? And, Alex, there's no right or wrong in this. It all depends on your mindset. If you feel that I want to get debt free earlier, then go in for prepaying the debt. If you feel, no, I want to create wealth and utilize it for other purposes, and, of course, you believe that your income will increase, and due to that, you'll anyway be able to prepay the loan earlier, then go in for that. But yes, you should have this perspective of what you can get on both sides.
Yeah, it's important that you point that out as well. And for everybody tuning in that's not familiar with this scenario, in a home loan, what happens is that you're better off prepaying in the first half of the home loan, because the way that the EMI is constructed is that in the first half, the interest component of the EMI that you pay every month is much larger, and in the second half, particularly towards the end of the home loan, the only thing that you're paying effectively in that EMI is the principal. And so if you get rid of the principal early, the interest incidence comes down quite dramatically. Now, Mrin, it's important to point out that this is a pretty simple calculation. We haven't even taken into account the fact that a lot of people in the past were also taking advantage of the old tax regime, where they were saying interest cost is deductible from your taxable income, and to that extent they were saving a maximum of 60,000 rupees per individual practically, and if it was a repayment by two individuals, then you could save potentially double of that, right? So we're not taking that into account, because I think a lot of people have moved to the new tax regime. Would you agree?
Yes, of course, the calculations did not take into account the tax regime. And the other point that I do want to point out is that at the end of the day, you're still paying the interest, right? So even if you're getting the tax benefit, there is still an interest outgo that is happening.
But then it comes to a few scenarios, right? We've assumed in this first scenario that you will get 12% over the course of the lifetime of the investment, which at this point, it must be said, it makes sense. But then who knows, in 10 years, you might have a lower rate of growth for India and you might have to reset lower. So we're making certain base case assumptions. And of course, interest costs could also, by that argument, go down quite dramatically. It may not stay at 8%. So equally, that is fine. But having said that, there are a few more scenarios that we can build in, right? To say that apart from this home loan, you might have other loans as well. So if you have multiple loans, what kind of strategies would you employ if you're trying to pay them off?
Yeah, so the typical strategy always when people have multiple loans is to always focus on the high interest loans first. So like credit card loans or like personal loans, right? Because you always believe, okay, I'm paying 17%, 40% out here as interest. So let me first get rid of these loans. But I think that strategy works when you have only like high interest loans, and typically most of them are lower tenor in nature. But when you have a combination of loans, so for example, when you have like a personal loan and you have a home loan together, that strategy may not work because, by the very fact that the home loan, the actual absolute outgo that you have every month and for a longer tenor as well, creates a very big impact. So if I can just explain this through an example, that let us say you have a home loan for 50 lakhs at 8% for the next 20 years, and you also have a personal loan for 12% for the next 5 years, right? So the total outgo, the total interest outgo that you're going to have in both the cases is, put together is going to be about 52 lakhs over this 20-year period, right? Now, typically, if somebody has money and they decide that I want to prepay the personal loan first, and of course, everything is assumptions here that we've taken. And, one of the things that I want to call out is that, each person really needs to sit down with their financial advisor and work this out for themselves, because there are so many different situations that can happen. And, and it all depends on which is the year that you want to do the repayment as well. But let's say we've assumed over here that the repayment is going to be in year 3. And then from year 4 onwards, you're utilizing that extra amount to repay the home loan, right? So in this case, what happens is that your total interest outgo from 52 lakhs becomes 41 lakhs, right? Now, let us assume that you think that I am going to close the home loan first, right? Because there's a higher amount of outgo. So you're going to close the home loan from the second year onwards. You're going to start paying 2 EMIs. So of course, here what happens is that because you're closing the home loan first, and again, as you explained, that in the first 5 years, it is basically the interest component that is higher than the principal component. So due to that, the total outgo on interest will reduce to about 38 lakhs. So as I said, there could be a lot of permutations. It all depends upon what are the loans that a person has. Ideally, what you need to do is make a list of all of these loans and then, work on an Excel to really see what makes sense to basically pay off first. But I would think that when you have high value loans, your focus should actually be on paying off the high amount loans first.
Okay, so that makes sense. Let's talk about a couple more things. One in particular, right? Because in the current juncture, you have the interest rate regime, which is moving to a lower rate regime, right? So the Reserve Bank of India has been cutting interest rates. It is possible that you might have another couple of rate cuts. And a lot of people are assuming that a further 0.5 percentage points or 50 basis points will be shaved off. And that means that home loans will be heading lower, the cost of home loans, interest cost. So therefore, the question arises that in a falling interest rate regime, what should your approach be? Because the two levers that you can use to adjust, one is the amount that you pay every month, and the other is the duration or the tenor that you pay. And that is true either when the rates are going up or when the rates are going down, right? So what is beneficial?
So when the interest rates are falling, clearly maintaining the same EMI is good, because what will happen is that the tenor is going to reduce. Since the interest rate has gone down, you're still paying a higher amount. So if you were to recalculate the EMI, then it will be a lower EMI. But you have decided to keep the higher EMI, which means that the tenor is going down. And it also really means that you're going to have a lower amount of interest outgo, and you're also going to close your loan faster. Right. So, of course, in the falling interest rate environment, it does make sense to ensure that you keep the EMI the same and let the tenor reduce. And of course, it's always helpful, irrespective of whether rates are going up or rates are going down, it's always helpful to make part payments, because part payments will always ensure that your interest outgo reduces. And, Alex, I think this is one of the things, right? Like, people don't realize that, even though the interest rate is at 8%, one feels that it's a very low rate and I'm generating a higher return on my investments. But the reality today is that the principal of the loan and the interest outgo is the same. So, for something that's worth 100 rupees, you're actually paying 200 rupees, right? And that's where I think the focus on any loan repayment really needs to be on reducing that absolute number.
Yeah, 100%. I think it's a very important point that you raise. When you're thinking of your returns from investments, you think about how quickly it will double, right? And that simple rule of 72 formula. So in a very simple example, you divide your 72 by the rate of interest that you're earning. So if you're earning 7.2%, then you're doubling in 10 years. This is true when you're paying something as well. So I think you raise a very, very important point. The last point has to do with how to, a few things to get debt-free faster. You want to run through the list?
Yeah, I think taking a loan only if it's necessary. These days you have all sorts of loans. So of course, I would say just try to stick to the home loan. And certainly you don't need early wage access and BNPL and these sort of things. And of course, like, keep increasing your repayments with the increasing income, and look at, using windfall gains also to repay loans. And of course, keep that whole, this whole aspect of getting debt free should be at top of your mind.
Got it. Absolutely. So, Mrin, thanks so much for this very important conversation. Hopefully, we've got people to look at their finances and drop their own calculations, because ultimately that's what you'll have to do. Thanks so much for taking the time. All right, now let's go to our second calculation, moving from a calculation on loans, which is on expenses, to returns, which is investments. And we're talking about the Employee Provident Fund, which is something that employees have to do. Of course, you can bring it to the minimum, but that's not something that most people talk about what you should do. And joining me now is CA Nitesh Buddhadev, who's a founder of Nimit Consultancy. Thanks so much, Nitesh, for taking the time. I saw this post that you had done on social media, and I thought it was an interesting conversation. Let's get into the scenario building first. What is the thesis that you are presenting?
Thanks a lot. Thanks a lot, Alex, for having me. When I'm looking or analyzing any number, I would like to go behind the headline number. That's exactly what happened when I was researching on the EPF numbers. So my book claim is quite bold when I'm saying that your 8.25% EPF can deliver better return than the 16%, maybe the equity one. Why I'm saying that, Alex? When I'm investing into the EPF, okay, as an employee, now there is two scenarios that either I have opted for EPF or I have opted out of the EPF, and the third scenario is that minimum 1800 of the contribution going from my end and also the employer's end. This is the normal three scenario exists when it comes to EPF. Now many people are just putting 1800, or I have seen many of the prospects which we come across are not putting into the EPF, and that's why the whole research started, that why EPF contribution is something quite relevant for your retirement corpus, considering the debt component and also in the new regime, Alex.
Important, and this is particularly after the shift to the new regime has become much more lucrative, I think, after the latest changes, and the fact that you're not getting ATC anymore, right? So your contributions to the EPF, which fell under that 1.5 lakhs of the ATC in the old tax regime, is no longer available to you, but the contributions that your employer makes is still relevant in that EPF calculation. But why are we looking at, first of all, employee provident fund and comparing it with equity. These are two entirely different things, aren't they, Nitesh?
True, completely, Alex. But I wanted to highlight the benefit of 8.25% interest because people are just going by the headline number. So, Alex, let me give you a case study, which I, of course, did on the social media, like you rightly mentioned. Let's say there are two colleagues, okay, working in the same organization, having the same basic salary. One has opted for the EPF, other has not opted for the EPF. And let's assume that 1 lakh rupees is the basic salary. So the person who has opted for the EPF, even in the new regime, he will contribute 12,000 rupees, which is 12% of basic. His employer will also contribute 12,000 rupees, 12% of the basic. Now, the Alex, like you rightly mentioned, even though I am in the new regime, the 12,000 contributed by the employer will not form part of the taxable salary. That is how it is adding a lot of value in terms of your return. So the 12,000 contributed by your employer, you have contributed the 12,000 rupees, which means you are investing 24,000 a month. 12,000 contributed by employer and 20,000 yours. 24,000 a month you are contributing. If I see the calculation at 8.25% return after 5 years, the corpus at 8.25% interest is 17.75 lakh rupees. Okay. Now, another scenario, the person who has not opted for EPF, now he will not be able to contribute whole 24,000. I am considering that because the 12,000 benefit which employer might have